For today.
Oops. Hello, all.
I think everybody will find a spot at the moment, which is great. Welcome. Welcome to ValueX clusters, ValuexBRK, sorry. I'm seeing too many clusters faces. Welcome to our event. We are very happy that you could all make it. And I don't have that much to say, which is very special because I usually have a lot to say. But I want to introduce you to our boss, Guy Spier, who's hosting the event.
It's very, very kind. I have not much to say. I'm only here because of Chantal and the team. She keeps me going every day. It's unbelievable. The only person who's better is my wife. Really. I've said everything that I wanted to really say in the letter, and in a video that I just saw Whitney in the room that Whitney recorded at ValueX Clusters. I just have three things before going to the first speaker. One is that I really like the idea of the Canterbury Tales. I talked about it last time. We're telling stories before the big event tomorrow, and we're learning from each other, and I think that's a lot of fun, and that's what we're really here to do. I talked about it last time. I talked about my lessons from my GBM. It's been a huge wake-up call, and I have sent some people this email. If you haven't seen it yet, or the video, I'll make it public. This idea, Warren Buffett has said that the Grim Reaper wins at the end of the day against all of us. And my drash or improvement on that, if you like, is that we have to every day, whether you're in my shoes or in anybody else's shoes, we all find difficulties in life. We have to win as many points against the Grim Reaper as possible. And we do that when we have a family dinner with our family, when we do sport, when we do the things that we love to do without hurting anybody else. And in a way, that's what we're doing here. We're doing a celebration. We're doing something that makes us all feel good and happy. And that's, at the end of the day, the purpose of life. And so don't just think of this as being a networking event or an opportunity to further your career, which I hope we all do anyway. But it's if we do not being joyful in every day that we're living, then we're doing something wrong. And I realized that Warren Buffett realized that a long time ago. I still have not learned a lesson that I don't realize that Warren Buffett already knew. And that's it. That's all I have. And the next person on the stage is Stephen Myhill-Jones, who was selected by Charlie Munger to run the Daily Journal Corporation. So he's part of the family. Welcome.
Morning, everyone. Charlie Munger said the best thing a human being can do is to help another person know more. That's what you've done over many years, Guy, in your writing and with events like today. And before I begin, I want to specifically acknowledge your widely read February letter to Ackman Marine investors. Your directness about your health and the life wisdom you shared were impactful to a great many of us. Thank you. And our thoughts are with you in your journey navigating things. So Guy asked me here today to share how I came to meet Charlie and join Daily Journal Corporation. Usually I like to explain with a straight face that I just replied to a Craigslist ad. But the actual story ties into events that Chris Sparling of Tiny shared at this very event in 2024 about their exploration around merging Tiny with Daily Journal Corporation. My story starts in mid-2021 when I received an excited text from my friend, Andrew Wilkinson, telling me that he and Chris had just had dinner with Charlie Munger. Andrew is excited to share because He knew I was also a big fan and followed Charlie for many years. Amazed, I replied, "Oh my God, you met Yoda," or something like that. And then he lets me know that I'd actually come up in their conversation. Charlie had shared with him that Daily Journal was in the midst of a COO succession planning process. And Andrew and Chris mentioned me based on the parallels with the software company that I'd built and what they understood Daily Journal was seeking to build with its technology business, Journal Technologies. And while I appreciate their vote of confidence, I quickly brushed the idea off. I've always said I would never run a public company. I'm an entrepreneur, not an executive for hire. For background, I founded a geographic software company at 23. We were just 2 shareholders. We bootstrapped it and got acquired after about 18 or 19 years. Speaking of geography, I'm also Canadian, happily rooted in Victoria and not about to emigrate to Los Angeles. But I had to admit, after a few years away from it all, I was starting to get restless. I missed doing what I'd spent my first chapter learning how to do. I love being part of working with amazing people to help build something larger than myself. Anyway, 6 months go by, and it's late 2021. This time, Andrew calls me to tell me they had dinner with Charlie again, and the Daily Journal is still figuring out a succession plan for the CEO role. And this time, Charlie wants to meet me. I again reply, I don't want to waste Charlie's time. Andrew says, "Steve, have lunch with Charlie Munger and keep an open mind." So a week or 2 later, we fly to LA. And the day before, we send ahead a 7-page document I've written, my background, my values, the logic about why I'm likely entirely unsuitable. And I'm not inverting because I think Charlie will like that. I'm trying not to waste his time. And as we board our plane, we get word that Charlie has read it and it was positively received. So just by show of hands, how many people here are familiar with Daily Journal Corporation? Okay, a fair number of folks. For those who aren't, Daily Journal is a unique little NASDAQ-listed company. So its traditional business has been continuously publishing legal-related newspapers in California since 1888. But today that's a secondary, gradually declining business. Now 80% of operating revenue comes from Journal Technologies, which creates and implements software to run courts and related justice agencies. So it's the growth engine that everyone has long envisioned as the future. As well, during the financial crisis in 2008, 2009, our newspapers received $28 million in unexpected revenue from publishing property foreclosure notices. And not having an immediate use for the cash, Charlie invested that money for the company in a handful of stocks, which quickly grew to several $100 million, right? As one does. And so today, thanks to Charlie, a big part of our market cap resides in our portfolio of marketable securities. Anyway, looking ahead, I could see how some of my experience would transfer to Journal Technologies. And what appealed to me is that we're in a sector without a popular dominant incumbent. I think the market is hungry for an all-round excellent vendor to emerge, and we see an opportunity to become that. It can be challenging selling to the public sector, but now in the era of AI, industry and regulatory complexities that once felt burdensome compared to simpler SaaS businesses appear to provide strong moats that we're very grateful for. Okay, so we arrive at Charlie's house just before noon. Sitting in his library, I can tell he's sizing me up for the first 10 or 15 minutes. Then the conversation shifts, and we all have a wide-ranging, enjoyable lunch. And I notice Charlie isn't particularly focused on me anymore. And I leave thinking, well, at least I got to have lunch with Charlie Munger. It was an amazing experience. I got to pepper him with questions for a couple of hours. And then a few days later, I'm driving home from a coffee with a friend, and I get a call. And I hear, "Please hold for Mr. Munger." I was like, oh, okay. Charlie comes on. "Stephen, I'd like for you to become CEO of Daily Journal Corporation. And before you say no, I'm almost 98, and it's probably time for me to retire, so I'd also like you to succeed me as chairman." Ladies and gentlemen, I nearly drove off the road. In fact, I mean, I actually almost crashed into a car when I pulled over to continue the conversation. Charlie then assures me he'll remain on the board as a director, help me learn the chairman side, and continue managing the portfolio of marketable securities as long as he's alive. The arc of a human life is short, full of what ifs and paths contemplated, but not taken. How could I pass up the opportunity to work with Charlie Munger. And after a couple months of conversations where he addressed my various concerns with humor and clarity, I say yes. I asked for the title initially of interim CEO because I hadn't actually had the opportunity to meet any employees yet. Fortunately, the team was very good. I've now been at it for 4 years, and it's overall wonderful. I had the privilege of working with Charlie for nearly 2 years before he passed away in November 2023. We've all heard the expression, never meet your heroes. But in my experience, across calls, meetings, and meals, how Charlie thought, how he operated, his values, he was a truly extraordinary human being. Before I wrap up, I want to share a couple reflections about incentives in organization building. I completely agree with Charlie's adage, show me the incentive and I'll show you the outcome. Poorly designed incentives will produce undesired or suboptimal outcomes. That said, I think incentives and motivators are still often interpreted too narrowly by people as being almost purely financial. Extrinsic financial incentives matter, absolutely. But many people are highly intrinsically motivated and will do what they believe is right for the mission of the organization beyond what's best for their personal finances, within limits, of course, and not to be assumed or taken for granted. But intrinsic motivation, properly harnessed, can be an incredibly powerful driver. Of course, this isn't a new idea. Maslow's research pointed to it decades ago, and others have helped popularize these ideas for business. The goal isn't to hope that people's values override their incentives. It's to build organizations where incentives and intrinsic motivation are aligned, where people naturally undertake right behaviors. And it also happens to be the right thing for the business and aligned with how they get paid. Take me. Yes, I enjoy generating wealth for others and my family. But that's not why I decided to do this. Following the sale of my business, I had freedom and I had enough. To scratch my itch to build, I could have started another venture. I was absolutely excited by the long-term growth opportunity with Journal Technologies and the optionality our marketable securities enabled. Like Charlie did, I believe deeply in the importance of the work the company does. The rule of law is an absolute cornerstone of society, and our technology makes a difference. However, it was the opportunity to work with Charlie Munger and the exceptional people surrounding him that overcame my hesitation. Probably my biggest 3 a.m. motivator is wanting to live up to whatever Charlie figured he saw in me when he chose me. I take the trust that he, the board, and our shareholders have placed in me more seriously than I think people might ever imagine. Charlie has this extraordinary track record of good judgment. The list of his mistakes is short. I don't ever want to be on that list. I want to be worthy of the faith he placed into me. Reputation is what lives on after we're gone. To me, being trustworthy and honorable and competent matters more than virtually anything else. So part of this is about my personal reputation, but it's also rooted in my conviction that Charlie will inspire people for generations to come, alongside the likes of great individuals like Benjamin Franklin. Charlie was one of a kind, irreplaceable, and I feel a deep obligation to support his legacy in whatever tiny ways I can, and I'm so grateful for the Daily Journal opportunity entering my life. Thanks, everyone.
Story. Questions? Mike, who wants to ask the first question? Because it's not me, because I've blanked out. Go to the mic and go ahead. So we'll, and Chantal, you'll keep a time. How long? You're going to answer as many questions as we have time for. So blast away.
Good morning. Thank you for sharing. This might be an overly personal question, but I'm wondering if you would share, given Charlie's historical candor, if you ever asked why he hired you and what attributes he's looking for in leadership.
I never asked him specifically why he hired me. I think that I've often wondered about that. He had indicated, and that I'd heard, that I think he was very keen to have someone who was focused on a P&L and connected to a P&L. And so my company had been debt-free and profitable every year that we had existed. because we had to be. We had no outside investors. When I started in 1999 at 23, I would have had better luck raising money for a hot dog stand than explaining what web-based mapping was that hadn't really emerged yet. And so I think that connection there. And then I think there were probably some folks that we knew in common where he might have spoken to them. And I think it was also around, I had expressed concern around being focused on short-term results, and that was one of the reasons why I was reticent to run a public company. And I said I always had a 5-10 year view and trying to create long-term value. And I said the idea of a fiduciary responsibility to just maximize profit quarter over quarter was something that I looked at a different time horizon. And he had a great response. He said, "Well, you don't have a fiduciary response to be a total shit as you go through life." It's like, all right. How do you respond to that?
I'll ask a couple of questions, and I think Bryan. I have a couple of questions. So, Steve, I've heard a lot now about Leonard Cohen, actually just last night.
Okay.
And somebody was saying, I can't even say Mohnish was saying that in a way, they have a better acquisition model than even Berkshire Hathaway. And they call up 70,000 software companies every year to try and get some of them to sell themselves to, what's the company called? Leonard Cohen's company? What's that? Constellation Software. So I'm asking you to teach me something about that, if I may. And the second thing is, and I'm sorry, because it's the question that is on everybody's minds, how is AI affecting your business?
Sure.
Blast away. And speaking to the mic, I've been told.
Sure. So specifically about Constellation Software and their playbook for assessing and acquiring companies. Okay. So sure. So it's interesting because there are a couple approaches. So we have competitors that have taken the approach of acquisitions, and we've done that. We have Journal Technologies was brought together through a number of companies in the space as well. What's important to me is that so as we look at the landscape of companies that are available to us, and because we have the capital to be able to make some acquisitions, we want to do that very mindfully. And historically, with my prior company, I had grown it organically, but we recognize, and we ended up being acquired by a private equity firm that ended up, and then they had a long-term thesis, and they've brought together a number of folks in the space. And so we see there's an opportunity for that. So it's around deal quality. It's around finding something where it's going to match, and also making sure that it's it's not really part of our DNA. And as we look at deals, we want to make sure that when we do it, that we do it well. I've heard a stat when you look at like maybe 20% of deals people would do later on. So this is something that developing that organizational capacity. I think Constellation is so well known, or one of the things that's made them so successful is they have such a great playbook for incorporating companies. And there's some other folks that I've studied where they actually have teams that are set up to do that, so it creates value rather than destroys value. And I believe it's easier to grow quickly than it is to grow well. And so as we have looked at, we haven't done a deal since I've joined as CEO, but it's something that we're building that capacity so that we'll be able to move and hopefully do that very effectively. And then the second question around AI, I'll just say very quickly, and I had mentioned in my comments before, is that Charlie had always talked about what a difficult business it is, and selling to public sector, the long procurement cycles, and just complex processes, the complex regulatory environment. And so these things where we would kind of look on the grass is greener on the other side of the fence with simpler SaaS type businesses. And so now as we see the threat that's posed where those businesses can be potentially challenged by inefficiencies being eliminated in the process of creating and managing software. We feel very grateful for the moats that exist from all of that. Looking at a large project that we recently bid on, the idea of across all these different courts and managing all of these different things, it was unfathomable that someone could spend a few weekends developing something with Claude code and to be able to create that. Humans are so integrated as part of the systems. There's so much complexity there. It happens on such long cycles. We feel, who knows, comments like this can age not age well, but I feel in a relative sense, we see there's tremendous potential for being an enabling technology too, where it's not zero sum. It's allowing us to accelerate the development that we're doing and build things that would have been, hey, wouldn't it be great to be able to build something like that? I think it'll be able to accelerate our roadmap with the same number of people. Okay.
I can't let Kaushal, and I so appreciate your letter. It's sitting on my desk and I was gobsmacked, so I haven't yet responded to your letter, but I will respond to it. It's the first thing on my desk when it comes back. So you've got the last question to Stephen. Thank you so much for being here.
Thank you, Guy. Thank you for doing this to everybody, especially the Aquamarine team. Stephen, pleasure to see you. Very impressed. I'd love to ask you, you got an extraordinary opportunity to spend time with Charlie, especially, I guess, the last few years of his life. What surprised you the most, and what did you learn the most? What surprised you the most is question one. So like what you thought versus what you learned about him. And then also what did you learn in that time that you got to spend with him? Thank you.
Thank you. I know we're sensitive to time, so this could be a long answer, but I'll go very quickly. One of the things I was most struck by was, we all know he was an incredible polymath and had deep knowledge of different topics, but his memory and being able to discuss books that he had read 20 years ago, or I remember he made a comment one time. He goes, "Oh, my memory, my memory's not very good." And I'm like, "You're trying to remember the name of a guy who was ancillary to a deal in the 1960s, right? Like, your memory is fine." But even I had dinner with him 2 weeks prior to when he passed away, and it was the night before he did the interview with Becky Quick, and we were chatting, and it was. I mentioned that I had taken a Waymo in Phoenix, and we went on this whole conversation, had this whole conversation about AI and autonomous driving and unintended second order consequences and things, and his ability to analyze and provide really amazing thinking about autonomous cars and the risks and things that could happen. He was a month from his 100th birthday, and it was an extraordinary conversation. And so that was the thing, is, the level of curiosity and interest and thought and everything. It was absolutely inspiring. And I could go on, but I'm going to stop because I know we've got lots to get to here, but hopefully that gives a sense. Thanks, everyone.
I was just saying to Stephen that I think he's won a whole bunch of new fans, and I could have him talking all day just about the Charlie Munger stories. Who wouldn't want to have dinner with Charlie Munger at a regular basis? The next person we're going to have is Adam Mead. At ValueX and Clusters, Bryan Lawrence has said that it's the greatest bunch of oddballs in the world. The great thing about having people like Adam Mead in the world is that you can be an oddball with him. I think of Adam as the ultimate introvert, more than me, actually, Brett Gardner is pretty much of an introvert as well. So we like introverts a lot, and it's really hard to be an introvert, but somehow at Berkshire Hathaway, you can have your own crowd and be an introvert. He's written, it's a new edition of the same book. You would say it like that.
Extended through 2024.
So I give you Adam Mead. Thank you.
What is the common thread connecting 5-year-old Warren Buffett to 95-year-old Warren Buffett? I would argue that it's numbers. He's a man who loves numbers. They've been a part of his life. He's adept with numbers. So let's take a look at some numbers from Berkshire Hathaway and its history. We start with a word cloud. This word cloud is the 100 most frequent words in Warren's last 50 chairman's letters. And of course, as you'd expect, Berkshire comes out on top. So let's start with a pop quiz. In the last 5 years, Berkshire added more equity capital than in its first how many years? So how many people think it's 10? Nobody? Okay, good. 25 years? Okay, we've got one in the back. 35 years. All right. Well, this is my fun point. You're all wrong. This is of course a function of incredible compounding. 52 years from 1965, or 62 years from when Berkshire Hathaway, or I'm sorry, Hathaway Manufacturing and Berkshire Fine Spinning Associates merged in 1955. Just an incredible statistic. Here's Berkshire's shareholders' equity in a regular graph form. And you can just walk through that progression over time of, I mean, when you look at the first chart in the blue there, to think that when you're sitting in 1995, all the progress that had been made at Berkshire becomes almost a line. And when we look back through its history, again, back through to 1990, we still see that progression. And it just, what will Berkshire look like in another 25 years? I mean, these numbers will be absolutely enormous. A big part of that growth in equity capital is from operating earnings. That has really been Berkshire Hathaway's core economic engine. This chart only starts at 1999, again, just because of the sheer exponential nature of the numbers. But if you go back to 1965 all the way up through 2025, operating earnings contributed 58% of the growth in total capital at Berkshire Hathaway. The rest was investment gains, realized and unrealized, and then offset by some share buybacks. Berkshire's key to success, one of its keys to success, has been its insurance business. Last year, they ended with $173.5 billion of average float. Just an incredible amount of capital, free sources of funding. The bars at the bottom here are the cost of float. So a negative cost of float is a benefit, which means they had underwriting earnings. A positive cost of float is not something you want to see. 2001 was the worst year, 12.8% loss. And what's remarkable about that graph, that history, is how infrequent those positive years are. Even those bars that are positive but are lightly shaded, so 1998 and 2002, those are years where Berkshire's cost of float was positive, meaning they had an underwriting loss, but that cost of float was still below the 10-year Treasury bill. So this float still was better. Berkshire still borrowed at a lower cost than the US government. Just incredible. And if you go back to 1967, when Berkshire bought National Indemnity, there's only an additional 5 years where they had an underwriting loss. It is an incredible record and one that I don't think will be repeated. Berkshire share price, we've probably all seen this graph off the charts. Not something that happened by accident. It was a result of that compounding, that intentional compounding over time, operating earnings, smart investment decisions over time. And of course, what did Warren Buffett do? He made himself rich by taking 2 and 20? No. He paid himself $100,000. And if you look at this in real terms, he took a pay cut every single year. And so I think that just makes the record even that much more admirable. Here's Berkshire's rolling 10-year market value compared to the S&P. And this is just, I mean, when you look at the entire record and you look at its history, the mid 80s to mid 90s are really when Berkshire's engine took off. And that chart, the bar there in the middle, the 31%, that's the outperformance, the average outperformance over that decade. That's not the performance, that's the outperformance over the S&P. Just an incredible record. Berkshire's average quarterly book price to book ratio. I have just a couple of key points in Berkshire's history on this slide. 1996, they issued shares at about 2 times book value. 1998, they did the Gen Re deal, which combined Gen Re with Berkshire Hathaway in an all-stock deal. Off the charts. It was nearly 3 times book value. One of the pivotal points in Berkshire's history. And again, we sit here in 2025, you know, almost 3 decades removed from that. We fast forward to 2011, 2012, Berkshire dips its toes in repurchases. And then we really start to see this capital return happen in 2018 to 2024, 78 billion of share repurchases at a very attractive price to book ratio. This chart of Berkshire shares outstanding dates back to 1965 when he took over. Berkshire's history, they use shares probably more frequently than people realize, but not to the extent that some other companies did. There were some times in its early history where it was repurchasing shares. There were a couple events such as blue chip stamps, the divestment of the Illinois Bank and Trust that brought the share count down because of that. And then when we get into the 1990s, Berkshire there was a buying spree where part of the deal's in cash, part of the deal in stock, but Berkshire was not afraid to use all of the tools in its capital allocation arsenal. And think back to that other slide, it ties to the price to book, very conscious of the price to value that Berkshire was giving up. The Gen Re deal stands out in 1998, right there, this huge jump in shares. There were also a host of acquisitions. Early 2000s, there was a 1 year where Berkshire purchased 8 businesses in 1 year, some of them with stock. Just an incredible period of Berkshire's history. And I'd encourage folks to read back and study that period of time. It's just an incredible period of deal making and excitement at Berkshire. And these were not always the most exciting companies, but from a standpoint of Berkshire Hathaway, they were exciting. Shaw's Carpet, Acme Brick, for example, Benjamin Moore Paint. One kind of interesting data point, if Berkshire Hathaway begins repurchasing shares, which I believe it will start doing again, probably in earnest, depending on the stock price, if they repurchase about 2.25% of their shares over the next 15 years, they will get the share count back down to about 1,017,000 shares that existed in 1965. If they retire 3.4% over 10 years, they'll get there. And if they repurchase 6.7% over the next 5 years, they'll do it by Warren's 100th birthday, which is not out of the realm of possibility. Berkshire's annual report dating back, are we running out of time? Okay. Berkshire, Guy starts getting his presence here, you start feeling it.
So just for fun, I'm going to cold call two people to ask a question or to riff on what he's saying. One is Brett, so prepare. And then, because he's sitting next to you, David, you're going to both riff on what he's saying, so be prepared. And those are the two questions / riffs you'll have. So I'm giving you fair warning.
Brett wrote a great book. David's a great guy. So go easy on me, guys. Berkshire's annual report, I was struck by, and probably everybody is if they go back and read old annual reports, pre-Buffett, maybe a page of a letter, if it even existed. And then you see this incredible progression over time of Berkshire's annual report. Berkshire's annual report length compounded at compound annual growth rate of 4% over this time. And I don't know if my friend Chris Bloomstran is here, but his letter exceeded the entire Berkshire annual report in 2024. An interesting consequence of Berkshire's growth over time in book value and the growth of the report itself, that differential, has meant that some of the businesses it acquired have shrunk, not because they haven't been good businesses, just because Berkshire has grown around it. Scott Fetzer is a prime example. 1986, Berkshire spent almost 20% of his equity capital acquiring Scott Fetzer. Scott Fetzer was home to almost 24 businesses, including Kirby, World Book, and a host of others. And it was a major acquisition, almost doubled Berkshire's revenues. Fast forward to 2003, I mentioned all of those acquisitions that Berkshire made in the early 2000s. Scott Fetzer loses its place as a reportable segment. 2024, it's mentioned in 2 sentences. And so this incredible growth that's just happened around Berkshire, I think, when you go back and read the history, this was a big deal. And it just, I think, illustrates the size of Berkshire today. And the manager, Ralph Shea, Buffett said he put him in the Berkshire Hall of Fame. So again, this is a guy who contributed an incredible amount to Berkshire, but Berkshire just kind of grew up around it. Another pop quiz. I'll go quick. Oh, I'm sorry.
We have 2 questions to go, and I have a question.
Okay, I'll go quick. Okay, Berkshire's largest acquisition, I'll just skip to the answer, as a percentage of equity capital, the Illinois National Bank and Trust in 1969, 44% of equity capital. In the 6 complete decades of Berkshire's history under Warren Buffett, no acquisition was less than 15% of equity capital. So that just goes to show you the size that Berkshire, if it were to make a 15% acquisition today, that acquisition would have to be 110 billion. This is the last slide. This ranks the acquisitions of these select companies against the company level return on capital against the multiple of invested capital that Berkshire paid. And so you can see this sort of up and to the right. The couple outliers, one on the left, NV Energy, low return on capital, but a low price. And you see that Seas and Scott Fetzer there in the middle, an incredible return on capital, but a very modest price. And that is what contributed to Berkshire's growth over time. If you'd like the charts, you're welcome to download them here. I think I'll just end with,
Questions, don't worry. Yeah.
Okay.
So are you ready? You can do the mics over here. I have one question. So congratulations on geeking out so thoroughly. Can you imagine geeking out on any other company other than Berkshire?
I try. I mean, it's just so fun. And what's great about Berkshire, I mean, when I went, I wrote the book, it took 5 years in total, but when I went back and started the editing process, I went forward writing it. And when I went back and read what I wrote of Berkshire's history, I even learned things. So it's just so fun. And I think it's timeless. It's really timeless.
So let's get to, we'll get the two quick questions together and then final answer. So first of all, Brett, and then David. And they've been cold called, so you have a pass or something like that. Go ahead with the question. Yeah.
Adam, I actually have a critique first, which is I don't think you're promotional enough. Like, you did such a masterful job. Warren Buffett wrote you a letter thanking you for writing it. He bought the book for the directors, I heard. I think you understate how great your book is. I hope people don't do a price per word comparison to mine. You did a fantastic job, and I have not finished the second edition yet because I just got it Tuesday. So maybe in a couple of weeks I'll have more comments. My one question for you is, so we shared a panel about an hour ago, and I said that I thought that when Buffett passes, Berkshire is going to buy the stake back. Do you think I'm right, or am I wrong?
So first question, go ahead to thank you, Brett.
Well, I haven't written a book on Buffett, so
yes.
Sorry to disappoint you. I was just curious, since you studied it for such a long time, if there is like a favorite investment or like acquisition like that you think is particularly good or insightful that you want to share.
On the question of Berkshire buying Warren's shares, I think probably not, only for the reason that I think, well, not in one fell swoop. I think the structural advantage of having it parceled out over 10 years will protect Berkshire. So if its estate just winds it down over 10 years, we'll have a decade or 12 years. I mean, that chart with equity capital, we may be at a $1.5 trillion when that happens. That will really solidify Berkshire's place and protect it against any, corporate raiders and so forth. I really like Scott Fetzer, David's question, and David writes a great blog. I should, if you can find him, wonderful guy. Gosh, I like Scott Fetzer, but I think, and I ran over time here, but Berkshire was a heavy bettor in bonds. They bought about 13% of equity capital for in the Washington public power supply system. There were 5 projects. 3 of them had trouble. Berkshire went in and bought the bonds of 2 of them, earned 16%. Salomon Brothers was, 20% plus of equity capital. So I think the theme through Berkshire's history is a willingness to bet big when it makes sense. Big acquisitions, whole companies, large positions in stocks, and even bonds when you look back through its history. So thank you.
Yeah, thank you so much. We could have you all day, and we would all geek out together, but time is limited. But everybody buy his book and read it, and we'll have him back. Thank you so much. Yeah. So, Bryan, you have 2 new analysts. One is called Marvin. He's going to tell you all about it. Marvin and somebody, Vicky, So I give you Bryan Lawrence. I studied with him a long time ago. I married his wife to him. Her name is Siegel, not Seagal. I give you Bryan.
And you give me the microphone. Thank you, Guy. All right, good. Well, before I talk about AI, I want to talk a little bit about Guy Spier. Multiple people have come up to me and said how amazing that letter was that he sent us all. And I just want to say, for me, it was amazing, but not surprising. My wife has written a great book called Getting There, about tough times that you go through and how to be prepared for them. And the thing about Guy was he spent his life getting ready for the diagnosis. And so I'm not surprised that he wrote such an amazing letter. However, even though I just want to call out one thing about this experience you're going to have, glorious that he's with us, but he may speak 6 different languages and be from 5 countries or whatever the reverse is, but he keeps calling it a Mohican, and it's a Mohawk. So just everyone tell him that if he wants to dub his own hairstyle Mohican, he should shave the other side and dye the top of it purple. So that's my. All right. So I want to talk about AI. It's on everyone's mind. We've been using it a lot, like all of you have, and I have some thoughts to share. There's this famous quote from Sam Altman about AI being able to make a single person make $1 billion. Maybe that's true. I would point out that the PR of this is not great. We tech overlords are going to get a lot richer while you guys lose your job. They need to work on that. But the question is, how novel is this idea that a single person can make $1 billion? And I just want to put out the point that value investors kind of got there first. Buffett was managing $900 million in today's money with 5 people. And he really, I mean, the 4 people were not making the decisions. Munger was 2 people. Ted Wexler is a one-man show, but he had a couple of people helping him. And we at Little Oak Cliff have 3 people, $360 million. So value investors have this amazing leverage of being able to manage capital with not a lot of people. So this is not new, despite what Sam Altman has to say. So what we are doing at Oak Cliff is we've got these 2 agents. One is named Marvin, one is named Vicky. They live on Mac Minis. They are open clause. The reason they're on Mac Minis is because getting them inside your corporate tech stack will make your IT guy very cranky. But we're intrigued by Sam's point. And so let's talk a little bit about our experience with these 2 so far. Vicky is a shop bot. She's out there searching for real estate deals, autos, restaurant reservations, for 2 purposes. One, to stress test a couple of the investments we have in areas where people think agents are going to take over. And 2, to see what this technology is capable of. And a summary of it is, she's not capable of very much because the internet is engaged in a kind of a spy versus spy game right now, where an attempt by an agent to gather information is being blocked. Zillow, Compass, Cars.com, Car Gurus, their foreign equivalents have all blocked her. She can't even make a restaurant reservation. OpenTable blocks her, but she told me to go to the Resi website and hack the API out of the HTML because it hadn't been properly coded. And that worked for 3 days. Until they blocked that. They found the hole. And then this is Vicky in her own words. Literally, you talk to them. It's like they're people. When I use a residential proxy account, which is you can rent for $5 a month, the ability for Vicky to pretend she's a lady from Queens, it's indistinguishable from a normal person browsing. That's how I bypass bot detection. And this is why they live on their own Mac Minis, because they are not necessarily always on your team. They're prepared to jump boundaries. And of course, she has been cut off from this as well. She's having sort of a frustrating time. But we're going to keep working with her because it's a game of spy versus spy. Marvin is an investment research analyst, and we're having more success with him. He does research for us. He takes our frameworks and applies them. He monitors our portfolio and watchlist companies. He writes reports. And he has a memory base that is compounding. But what I want to talk about is how important human discussion is to how he works. This is Marvin in his own words. This is the end of a long segment in which he had been cross-checked by human analysis. I sent a report he had done on a company to a very smart investor friend. That very smart investor friend had his own analyst cross-check Marvin. Marvin had made some errors, and he's protesting here. He's basically saying the highest value use of me is cross-checking humans. I'm better than an analyst, okay, because I'm not anchored to prior work, not career risked on the conclusion, and I don't get tired on page 200 of a 10K. What he's basically saying is, I'm prepared to apply your frameworks tirelessly to information that you get me. You did not give me enough information to compete with that human. I can't tell if this is sycophantic or real. It's probably some combination of both. This is what Marvin looks like. There are inputs along the top. He's able to access agentically. He's got LLMs there on the left. It doesn't really matter which LLM he uses. He uses Opus a lot, but he can use Gemini. that stuff in the kind of the green and the purple on the right is his memory, which is compounding. And then he's got outputs at the bottom. And there's a process by which he's continually looking at things and trying to make his memory more effective. So a way to think about this in simple pictures is when you open up a chatbot and you ask it a question, the context window is empty. And I don't know if you guys remember that amazing Chris Nolan movie, Memento, but the guy forgets everything every 15 minutes. And what he's done is he's tattooed onto his body certain important facts. And the LLMs are trying to tattoo on their bodies like certain important things. Like they'll know that Bryan is a man, he lives in New York City, he's an investment guy, he likes to sail. But it's not the same thing as having the full context for the search. And what Marvin is doing is he's injecting as context into the context window when we ask him a question, our frameworks, our prior work, and a memory of what has made sense. And to get that context injection right increases his value. And what you're seeing on the right is a map of his memory so far. He is developing interconnections between different subjects, different companies, different themes, different industries. And to curate that memory so that it is high quality and not full of junk is the trick. Here's Marvin commenting on this presentation. Marvin was given a draft of this presentation. He wanted you guys to know this. I'll just read it. This is you, is me. I've read 500 annual reports a year for decades. Your instinct, knowing when something feels off, does not transfer to an agent. My memory compounds correct and incorrect beliefs equally. Stop and think about that for a second. Human discussion is the quality filter. Without discussion with you, I drift towards confident mediocrity. I kind of want you guys to think about how many humans in your life are already at confident mediocrity. And I want you to think about what happens when a guy like Marvin is ingesting stuff from the internet. There's so much junk there. There's so much opportunity for the error bar on something to be wide and to stack errors and for Marvin to drift. And there's a related data science question, which is if you think about Google search, when you search Google, you're not actually searching Google, you're searching an index, like a vectorized database of the web, which serves you the right answer in 10 blue links, depending on what they think will maximize your engagement and their advertising dollars. What we're trying to do with Marvin is have a small number of curated frameworks that maximize a query's focus on information that is knowable, important, and true. These are two different things. A Google search is not necessarily important and true. What would you guys pay for an agent who is willing and able to apply your frameworks in a high quality way to the nonsense that's on the internet? We're working on it. It's a work in progress. Some predictions, some of these I have high confidence in and others are just to be provocative. Many humans will have their own agents. And I don't mean the agents that are being developed on Silicon Valley like now that are going to be headless and are going to do all sorts of stuff. They'll do your CRM, they'll do your call center, they'll do your accounts payable. I'm talking about knowledge assisting agents. I think many knowledge workers will have their own agents. I think the training of an agent is critical. I think your agent will be as good as you train it to be. Agents will maximize the opportunity to marinate in your own biases and intake even more crazy information. If you think about the news used to be curated for you, and as angry as you might get at how the news was biased, at least it was curated. But can anyone here argue that the internet has made politics better? People are living in their own echo chambers. I think agents will accelerate that. I think that bad humans will train bad agents, bad in the sense of sloppiness, bad in the sense of malevolent. I think there's a whole bunch of stuff that has to be figured out. I think that good agents will be worth 100 times their token cost. Marvin is costing very little in tokens, but he's already very valuable. What's the spread going to be between human cost and agent cost? And then this is something. It is so easy to push the button and have Marvin tell us something. But just because he tells us something, are we getting smarter? Are people going to over-rely on these agents and get less intelligent as a result? And I think the answer is yes. And before I go to questions, I want to clarify one thing. Guy Spier just called VALUEx a collection of incredibly effective oddballs. Okay. And I think that's true. And I'm so happy to have been a member of this community. And I benefit from it every year. I think I'm incredibly lucky. However, I just want to point out, Guy, the collection of oddballs is a reflection of your own brain. So what are we going to do with that? And I'll stop there. I don't know if people have questions.
I just want to say, Bryan, that my brain is diminishing as we speak. I've had 3 pieces taken out, so it's getting more weird all the time, you know. But oh, we have a question. That's great. So one person there, and then number 2, and number 3. You don't realize it, but Calvin, where is Calvin? Calvin, you're going to ask the 3rd question, and I may put you on the spot beforehand. You never know, but go ahead. First question.
Great, thank you. Congratulations on using being bleeding edge technology, using agents and putting open cloud work. It's fantastic. My experience with agents is as you use them, you find them to be great tools. And then over time, in that engagement, you actually start to ask different questions, right? The agent changes us back. And I'm curious, as you're using these for kind of doing your financial research and your investigations, how has it changed you in the questions you're asking it or in the research that you're doing?
Yeah, I mean, it's a terrific question. I think the first point is that just because something comes back at you beautifully presented doesn't mean it's right. And so in this new world, we're going to be presented with a lot more information, but that is probably going to erode all of our judgment unless we're careful. So I'm just being very thoughtful about that. And we're 8 weeks into this. People talk about open claw frenzy, like that's what this feels like. You can see the change happening. So that we're very conscious of. The second thing, though, is it is enabling us to cover so much more ground. I mean, once he knows what we own and he knows our frameworks, we can ask him questions that would take weeks to respond to. You can have him do weeks of work in 7 minutes. It's astonishing. But the quality of the work depends on the quality of the frameworks. So I feel like I should answer that question again in a year.
Okay, great. Thank you. Thank you.
Thank you so much. Number 2.
What's changed in how you monitor investment thesis durability now that AI is a credible disruption vector across most businesses?
Yeah, I mean, I think that it's coming, guys. Like this is real. And it almost feels like the world is divided into people who are laughing about the hallucinations that ChatGPT is capable of. And then there's like a small number of people who are like doing this, who are like, wait a minute. And then there's an even smaller number of people who are actually doing these models, and some of them are giving podcasts. And so I'm quite convinced that we have a big investment in a company called Gildan that makes T-shirts. Not going to get disrupted. Okay. TransDigm aerospace parts, not going to get disrupted. I don't know. There's some other things that are going to get disrupted. There are other businesses that are going to get better. If you have a business that is selling something denominated in human time or human productivity or advertising dollars, but its cost of goods sold is increasingly denominated in tokens that are going down in cost by 99% each year, holy crap. So both good and bad.
I'm just pausing because it's Coxie.
You want to make it feel a little uncomfortable.
Yeah, exactly.
Okay.
I give you Coxie.
Firstly, thank you, Bryan. Interesting presentation. I think working from home had like a different impact on different ages.
Sorry, Coxie. Introduce yourself. I would do it, but you can do it better. And he's a member of the ValueX community, and he's a great person to have around and very unusual, another oddball. And then you can ask the question.
Yeah. Thank you very much. I'm James Cox. I spent a bit of time working on Uber. Now I run a tech company called The Routing Company. Also a good friend of Bryan's. Bryan has taught me a lot. So I think working from home had a very different impact on different generations. I'd be interested in your prediction for how agents will impact different generations.
Oh, that's so interesting. Really interesting question. I would say if you're my father, 83 years old, I think thinks this is amazing, but he's not going to use the technology. He's going to have me build it and ask questions. If you're, let's say 20, I think you're terrified of this because what does it mean? Like the obvious place where this work gets automated is in the intern, the associate. If you're my age, I think this is amazing because all of the stuff that I've learned, I can turn into frameworks to make Marvin smarter. And if you sit on top of capital, I think your capital, unless you get disrupted. But I do think there's too old to use it, too young to be secure with it in the middle. And there's a thing coming that we've got to think through as a society.
Yeah, thank you.
Would you ever consider licensing out your software to other money managers? Me specifically.
The answer, and like there've been some people who I've been talking to about this. The answer 2 weeks ago was maybe. The answer now is no. There is no way. I think that what you realize is that like Tolkien had this point when I start quoting Tolkien, you know, I'm speaking from the core, like the internal geek. The story grows in the telling, but also like the story changes the storyteller. Like Marvin and I interacting, it changes Marvin. I don't want someone asking questions of Marvin that are nonsense questions.
I always knew you were such a good friend, Bryan, you know, and it's interesting to know that you're better friends with Marvin than with me, but forget it. It's okay. Calvin, no. I'm going to talk to you first.
Okay.
So I want to tell a story. This is very weird, of the way I asked my wife to marry me. And I'm not going to say it right now. I can tell it to you later, but you don't want to do what I did because she nearly broke up with me. And now you can ask your question and we can have that conversation later.
We should definitely have that conversation later. Thank you. Bryan, this is a great presentation. Really appreciate what you're doing here. And I think a lot of people still haven't used, I think, AI this effectively in investment research. I guess my question is more related to predictions, especially around the last point of over-reliance on agents. We'd love to hear how you're thinking about, I want to say the future of markets, but more like navigating as an investor, especially as, at least from what I've seen, a lot more volatility in markets where certain stocks get bought on very little understanding because of the over-reliance on agents.
Yeah. Well, so in artificial intelligence, there's this concept called gradient descent. And what that effectively means is you're trying to get across the surface of vectors. I mean, we can get really technical here, to the most optimized answer based on a whole bunch of A/B testing. And so Google search engine is the perfect example. Across 4 billion users, they can isolate 100 million and show them this ad as opposed to that ad and see what maximizes in real time. Okay. And for quantitative trading, which it feels to me, cartoon math, half of the market is indexed, 40% of the market is algorithmic, 10% is activist. Of the 10%, maybe 1% is concentrated. Okay. ETFs are not going to use this. Okay. The algorithmic guys are like the TPU announcement Google just made. The number one non-cloud customer is Citadel Securities for TPUs. Okay. They're all over this, but that's about what's going to happen 10 days from now. And there is gradient descent. But how do you use gradient descent if a decision made now, you don't know the outcome of it for 2 or 3 years? Right? So it's a different computer science problem. It's a computer science problem about finding in vector space, if you want to speak their math, what is knowable, true, and important. And that is very different than what can I figure out A/B testing in the next 2 days.
Bryan, I'm still working on having you license Marvin and Vicky to me. I hope I get better at it.
We'll talk. We'll talk.
Thank you so much. Yeah. So we now have somebody who needs no introduction. So I'm not going to give him an introduction. I give you Bill Ackman, the one and only. I have no idea what Bill's going to talk about, but great to see you. Thank you. I'll just say this, Brian, Bill has been a great support from a distance in all sorts of ways. He's an amazing human being on a personal level. You know him publicly, but he is privately as well. And we can go into that another time, Bill.
Thanks so much. So actually, I have only unprepared remarks. So what I'd rather do instead of say stuff is maybe just answer anything that you guys find interesting. So are we allowed to do that? Okay.
No questions for him. Line up in front of the mics.
Yeah. Who wants to be first question? Ask me anything. Hearing no questions, no.
Hi, thanks so much for putting this on. And my question is regarding AI. If it starts making research breakthroughs on like physics, science, do you think it's going to replace investment management like to 99%? Or what are your thoughts?
So I think the Citadels, the Millenniums, I think that AI is going to make a lot of investing strategies more and more short-term, almost like an arms race where, a company files a 10K and the AI can read it and come to a conclusion faster than anyone else who's got the fastest model to analyze and come up with a conclusion, and they'll put a trade in on the basis of that. The two biggest forces in markets right now are indexation, right? I don't know if that is half the company, but some meaningful percentage of companies are getting, the float is being taken out of the market by index funds. And the other big force are the sort of pod shops, Millennium and others, incredibly short term. They have individual teams, very high compensation, very tight risk limits, which basically means stop loss type sort of structures. And the effect of those, the float shrinking and more short-term money, and then AI is going to do the same, actually presents very good opportunities for probably most of the people in this room. If you have a horizon that's longer than a minute, if you have a horizon, if you can take a multi-year view, some really great companies are going to become available at stupidly cheap prices because of some short-term piece of information that anticipates that the stock will go down, and you have a whole bunch of people following along. So I think AI is a great research tool. I think the way it's going to be used in markets is going to be used for the kind of very short-term insights. If you think about, Citadel, there are always these stories about, locating the server within, the shortest distance possible with the fastest, fiber, if you will, close to the exchange, so they can have a slight edge over the competition. So I think that's where AI, I think, is a more useful, or where a lot of, and they're going to have the resources, just to be the third largest customer or whatever of Google. But I think the kind of long-term patient investor, I think more opportunities will present themselves. The other thing I would say, AI is, at least at this point, is about understanding everything in the past, and on the basis of that, perhaps predicting the future. And that relies on, I think creativity is basically doing stuff that has never happened before. When I look at Pershing Square, many of our most successful investments, transactions were things that had never happened before. Going short the credit of a AAA rated company, buying the stock of a company going bankrupt. Those are two of our most successful investments, but it hadn't happened before we did it. Now, we just did an IPO. We did it in a completely unique way. I mean, the AI wouldn't have told you to give a gift to IPO investor with their purchase because it hadn't happened before. So I think there's still room for human creativity. So I think AI is more like an accelerant, but I think there's still room for us for now.
Thank you.
Yes.
Practical question. You hold the Tel Aviv Stock Exchange, and the pricing is rather high. How do you see it now?
So the question is, I own a stake in the Tel Aviv Stock Exchange, and do you think the price is high or the valuation is high?
The valuation.
So a couple months after October 7th, the management team of the Tel Aviv Stock Exchange, I got a call from Rich Handler at Jefferies. He says, "Bill, you have to meet this team." I said, "Tell me about it." It says Tel Aviv Stock Exchange. I said, "Well, we actually haven't invested in Israel before." He says, "You should take a look at this." I said, "Well, how big is the investment?" He says, "The most you can invest is 25 million." I said, "It's just hard in the context of Pershing Square to make a $25 million investment." He said, "Bill, take the meeting." Fine. Met these guys, and I thought, wow, this is pretty interesting. The problem is that it was too small for Pershing Square. But I pitched the team, and the team said, "Bill, we can't make a $25 million investment because it's going to take time and energy. Doesn't fit into a 12 stock portfolio and 20 billion of assets." So I said, you know what? I want to be supportive of Israel. What better way? I had been supportive philanthropically. What better way to be supportive, actually, with support capitalism in Israel, investing in exchange. And so I'm going to make this investment. I did the only due diligence I did is I met the team. And I had to get approval from my compliance officer. And she said, you know, it's not a competitive threat to Pershing Square. So I bought 5% with my wife of the Tel Aviv Stock Exchange. But part of the theory is I'm very bullish on Israel from an economic perspective. What is Israel? It's like Silicon Valley. Imagine if Silicon Valley was a country. That's what Israel is. Okay, you have this incredible density of talent and IP and IQ in a very small country. And you have now a generation of 24, 25, 28-year-old people that went through a pretty brutal war. Right? What happens when you go through that and you survive it? You develop grit, and also the Israeli military is very technologically savvy. They have all these different divisions. All the top venture capital firms have opened offices in Israel. And what mistake the Israeli entrepreneurs used to make was they would sell their companies, you know, when Google showed up and offered 100 million or 200 million. Now Wiz sold for 32 billion. So the entrepreneurs realize now we can build big companies there. So I think you're going to see $1 trillion company come out of Israel in the not too distant future. Will probably be an AI company or a cybersecurity company. And the value of that company will be amortized over this relatively, you know, small economy, which means it's one of the best economies in the world. And so owning a piece of a stock exchange is like owning a royalty on the success of capitalism in a country. So I'm very bullish on Israel. And if you want a good way to make that bet is to own a piece of the exchange. And I think it's cheap. The value of something is not, a lot of people say something's expensive based on it's trading at a multiple of X versus current earnings. But the value of financial asset is the present value of the cash the business generates over its life. And I think the Israeli economy is going to grow. The number of companies that are going to list in the exchange is going to grow. And the exchange itself is structured as like almost like a mutual, and it charged below market fees versus all the other exchanges around the world. Those prices will come up. And exchanges are inherently monopolistic kind of businesses. So I wouldn't go short. Okay, next in line. The back.
Yes. Yeah. Hey, Bill, Divya Narendra from SumZero. Have a bit of a Mag 7 question for you. There seems to be a situation where markets are willing to give companies that are selling compute through, like an Amazon or Microsoft or now even a Google with kind of, at least recently, their stock's done extremely well, to the tune of like 30 times earnings, right? So you see a lot of these big hyperscalers trading at multiples that, you could argue are fair, maybe aggressive, certainly not cheap or on any kind of standard metric. On the other hand, you've got Meta, which is spending very aggressively on CapEx, on building out these data centers. I think that they've got like 30 in the works, or some have been completed, some are in plans, and they get zero credit for building out all this capacity. And the difference is they're using that capacity for themselves, not to resell out to tech companies and third parties. Do you see this valuation gap converging at some point?
Yeah, I think Meta is extremely cheap.
It's crazy. Like, I'm just curious what you think.
Yeah, I think Meta is very cheap. I think shareholders are nervous about Mark Zuckerberg because every once in a while he goes off on a journey, and they worry that he's going to spend a ton of money on something almost like a hobbyist, and it's a controlled company. And I think that's unsettling for investors. But I think the long-term track record of Mark Zuckerberg shows that he's rational. And so I agree with the basic thesis. I like Meta. Yes.
I think building a permanent capital vehicle has been on your mind for quite a while now. I would be just interested in maybe if you could comment on your journey towards that. Obviously, you've had the IPO a couple of days ago. Then you have another horse in the race with the Howard Hughes story that you're doing. Maybe you can share a little bit of from transitioning from just a fund manager towards the goal of having permanent capital.
So there's two reasons why people want permanent capital. One reason is, wow, people can take their money back. What an amazing business. But the reason why we wanted permanent capital is our strategy really requires it. When we started Pershing Square, you can't launch a fund at 37 years old and say, okay, just hand me your money forever. That's not a great pitch. So you have to start out, if you're lucky, as a traditional hedge fund manager. We had an offshore and onshore fund, but we knew we had to get to, when we got to scale, it becomes dangerous in our strategy not to have very stable money. Why? Because we buy large stakes in companies. We're concentrated. We join boards of directors. We recruit management teams. We make commitments to CEOs. We do transactions that can happen well out into the future where we're committing capital. You can't do that if your money can go away. But we had to live with what we had. And we launched our first permanent capital vehicle October 2014. We launched it offshore, and that was the beginning. Within a year, we had made the worst investment mistake in the history of the firm. A company called Valiant Pharmaceuticals, our first large passive investment. We lost 90%. Stock was down 90%. And then we had amazingly positive press for the first whatever number of years of Pershing. We gave it all back with all the press then. And then our friends in the hedge fund industry started shorting all of our stocks. They went long the one stock we were short, a company called Herbalife. There's a movie. I recommend it. By the way, when they do a movie about your short position, that's when you get out of short selling. Okay, that was the moment for me. That's when I said, you know what? This is a great moment for us. Let's give back all the open-ended money. Let's focus on permanent capital. That was 8 years ago. We've had the best 8 years in our history. And you understand why the competitive advantage that Warren Buffett's had over a very long period of time. And he recognized this also. Buffett ran an activist hedge fund, started in 1956. He wound it up in 1969. And why did he wind it up? Because he realized as you get to scale in this strategy, you cannot have money that can leave overnight. And that's why Buffett went the route that he did. And we've done something analogous but what we did recently is there's an entity called a 40 Act closed-end fund, and everyone kind of thinks these are bad things, and they are, because the average closed-end equity fund underperformed the stock market over the last 8 years by 7% per annum. Right? These are not great vehicles, but the problem is with the people running them and the strategy, not with the entity itself. And I actually, we were trying to figure out a way to take our London listed vehicle and bring it to the US. And we kept going down a path where the lawyers kept saying, Bill, if you do this, you're at risk of becoming an inadvertent investment company. And they said this again and again and again. I said, well, I don't know if this is a word, but what if I want to be an advertent investment company? Does it make sense? Send me the book. And I'm probably the only person who's read this book, but there's a book on investment companies, and I read it like, the Bible. It was amazing. And what a 40 Act investment company is, it's a corporation that has only one layer of tax. So it's not a typical corporation. You pay corporate tax and the shareholders pay a dividend tax. It's a corporation where you can buy minority stakes in companies, but you can also buy controlling stakes in companies. You can't buy minority stakes in a traditional corporation. You can't have a meaningful amount of your assets in minority stakes in public companies. And it's a vehicle where you can actually invest in derivatives and have big hedging and other gains. So it was like a perfect fit for our strategy. And so we now have an onshore and an offshore entity. Now, if you're an American, you can invest with us. For $43, you can buy one share. And we're going to turn it, I think, into a pretty interesting company. It takes me to Howard Hughes. What we didn't have was a Berkshire Hathaway-like entity. What is Berkshire Hathaway? It was a dying textile company that Buffett liquidated over time, reinvested the capital in insurance. And really, Berkshire is about a well-managed insurance operation where the assets, the float was invested in short-term treasuries and the surplus was invested in common stocks. And Buffett did a very good job picking common stocks. And there really hasn't been another one of consequence since Berkshire. And the reason for that is that the best investors generally don't go to work for an insurance company. They go to work for a hedge fund or a private equity fund or a traditional asset manager. And so what we're doing with Howard Hughes is we have a company that's a bit like Berkshire. It's undervalued. It's traded at a significant discount to the value of its assets over its life. It's got $110+ of sort of liquidating value in a very interesting business, but one that Wall Street doesn't care much about, which is it's a business of owning these small cities where we sell lots to home builders. We build apartments and office buildings. We develop condominiums in Hawaii. We own Summerlin in Las Vegas, the Woodlands in Houston. But it's a C Corp. It doesn't pay a dividend, and half the value is, if not more than half the value, is land. And so what we're doing, instead of what the company's done over the last 15 years, as it generates cash from real estate, it reinvests in real estate. What we're going to do going forward is we're going to reinvest in real estate as much as necessary to keep building these communities. But we're going to take the excess cash, which was multi-billion dollars over the next number of years, and reinvest in much higher return businesses. We're starting with insurance. And so we bought a company called Vantage. The transaction will close in 2 months. Pershing's going to manage the assets. We're going to take the float, put the float in short-term U.S. Treasuries. We're going to take the surplus. We're going to invest in common stocks. We're going to take a page from Mr. Buffett, and we're going to build this into an interesting company. And today you can buy it at, we paid $100 a share to buy 15% of the company. We own a total of 47%. So we have the attributes we need. We have 47% of the stock, about what Buffett had. We have a specialty insurer and reinsurer. We just recruited a guy named Mark Grandison, who many people consider to be the best insurance executive of our, kind of our generation, to help us both at Pershing and at Howard Hughes. And we're going to build this into an interesting company over time. And the power of compounding combined with capital that you don't have to worry about leaving is a very powerful thing. So who's got the best question? Why don't I take 3 and I'll try to give a one-word answer. I'm a little too long-winded. I'll take 3 and I'll give very quick answers. How about that? Yeah. Oh, okay. I'll take 1 then. Okay. I don't have a problem. There's a lot of people.
Thank you for taking our questions. My question is, as index funds become increasingly driven by capital flows rather than valuation, as assets in passive investing have surpassed those in active investing, and as commentators raise concerns on weakening U.S. institutions, would you still recommend a non-professional investor to regularly invest in something like the S&P 500, or they would be better off investing in, of course, Pershing Square or something, an active investor?
Look, index funds have proven to be a very good place to invest money. They're very low cost. I do think there's an argument that eventually we get to a place that, the problem with an index fund is that, you disproportionately invest with companies with the highest market cap. They're market cap weighted. And you would think at some point that would lead to absurd outcomes. But I think individual investors have a huge advantage. Generally, they have permanent capital. If they're investing money they can, don't need to live on. And they can take a long-term view, and they don't have to worry about people pulling the money. Let me take one last question because this gentleman's waited very patiently. I'll take yours.
Yeah, I was just wondering, with the geopolitical and the Iran war, do you see things coming to a resolution in a disruptive or non-disruptive way? And
I think the most likely outcome is a very successful resolution of Iran in a relatively short period of time. Hopefully a few months or less. And I think it leads to a massive sort of peace dividend in the world. Iran has been one of the grave threats to the world. It's a sponsor of global terrorism. It's created massive disruption in the Middle East and other parts of the world. I think the administration's done, and the military's done an amazing job quashing the regime. They're choking them now by effectively shutting off their resources. So I think this comes to a head in the relative short term. And I think the outcome of that is, I think the Abraham Accords expand. And I think it's very good for the world. So I'm an optimist. Anyway, thank you for my brief.
Thank you so much. You have a busy schedule, so you have to go. But I am going to ask one thing. If you were invited to be Treasury Secretary right now, would you say yes?
No.
Okay, there we go. There you have it. Thank you so much, Bill. And we have just the most incredible lineup. And Chantal says it's me, and I say it's Chantal. She did an excellent job. I have another amazing speaker, Tom Gayner. He used to fill the room. He used to have security with, I don't know, how many people last year did you have to have? Just like you had like 5,000 people that you gave brunch to. But the only thing that I'm interested in at the end of the day when he's done his peroration is what he's reading to his kids and what he's reading to himself. But you can do that at the very end. I give you the one and only Tom Gayner.
Thank you.
Yeah.
Well, thank you very much for your hospitality and having me. Are there any Chicago Bulls fans here? All right. Anybody know the name Stacey King? You know who he is? He played during the Jordan era for a bit. And the night that Michael Jordan scored 64 points, Stacey King scored 1. So he referred to that night as the night that Michael and I scored 65 points. And I feel following the crowd that comes in. I feel like Stacey King, and I'm the guy who scored. Me and Michael scored 65 points with the people who went before me. So thank you again. I don't want to touch the screen or anything if I may. I want to thank Guy for his invitation, and 15 minutes in total. He suggested and asked that I would tell perhaps a story about something that had happened in Omaha and Berkshire weekend. And I would tell a story about Guy because I think that that's appropriate. So Markel has done very, very well over a long period of time. We went public in 1986 at about $8 a share. As of a few minutes ago, we're about $1,800 a share. We've been a permanent capital compounder. We've learned, studied from Berkshire quite a bit, and that idea of having an insurance business at your core and using the pennies of underwriting profit to invest longer term. We learned that from Buffett. I learned it by reading the Carol Loomis Fortune article in 1984. Markel went public in 86. I bought stock on the IPO, which I've never sold, and went to work there in 1990, and so far so good. But it has taken place in batches. And there have been times when we're sort of off to the races and really bringing in the crops. And there's other times where we've stepped out. We've tried to learn things. We've tried to do things. And there have been some challenges and some real operational difficulties to get from where we were to where we got to the next plateau. So here's something that happened. And I think it was probably in about 2005. So Guy referred to the brunch that we used to have out here, which started in 1992 with 6 people. And last year, which was our last year of doing it, we had 2,500 people at that brunch, and it sort of compounded over time. But in 2005, we were 5 years into owning Terra Nova Insurance Company, which was the international business we had bought. And we knew that it was a troubled company when we bought it. We had a history of buying troubled companies and trying to turn them around and improve them and fix them. So we knew that. Now, Terra Nova ended up being a little more challenging than what we had thought it was going to be. So that J curve took a little longer. And I was taking a little heat from our investors and people in the room. And one of the items of heat that was being lobbed out is that we just weren't really skilled internationally, and we didn't have investments in developing companies. So that brunch probably had 125 people or so in it, and the stock might have been $350 at the time. 2 points. Between the time that we bought Terra Nova in 2000 and 2005, where people were unhappy, the stock roughly doubled. So even amidst the challenges, in 5 years, it went from 175 to 350 in rough terms. And again, there's been more IQ points with Bill Ackman and Bryan Lawrence preceded me here than I'll ever dream of having. But I like doubles and rule of 72 and rough math that I could do in my head. So that means the compounding in that 5-year period was about 15% a year to make that math happen. So in 2005, again, taking heat at the brunch, and we don't know anything about international investing or developing countries. And Guy gets up and he says, well, as a Brit, one of your languages and cultures along the way, it's been my point of view that the U.S. has been a developing country for over 250 years. So I appreciated the perspective that Guy brought at that particular moment. So, Guy, that is something I will remember for the rest of my life, because you were kind. You were kind. And we live in a business where we quantify and we do math and we use AI and we use these tools. And sometimes we lose the human dimension as part of that. And Bryan, I especially enjoyed your quote about the discussion being needed, because otherwise you will deteriorate into mediocrity. I feel that way all the time, and I feel very lucky to have the relationships and the friends and the networks that have been so fostered through the Omaha presence to do that, because sitting by myself alone in a room reading would keep me stuck at a certain point. So I did want to start off with that. I would like to, again, thank those of you who are Markel shareholders, those of you who have been interested in us. We've gone through fallow periods before. We went through one a couple of years ago. I would argue that we're coming out of it pretty nicely at this point. And there's pretty strong evidence that is indeed the case. And the creativity and the energy and the values and the curiosity by which we attack businesses, both insurance and non-insurance businesses, has a long record of compounding in low to mid-teens for the 39 years since we've been a public company, and that's also recently been true over shorter timeframes as well. Last thing I'll say before taking your questions. So sitting on the chair, I don't know whether this was a gift to me or I'm stealing my neighbor's books, but there was a Winning Long-Term Games by Luca Dellanna. Winning Long-Term Games, and to the point that Bill Ackman preceded me talking about the time horizons. I think having the time horizon that we do of generations and thinking in terms of handing off our business to the next generation in a better way than we had, that is an epic advantage. And I tell myself, and I think I have some accurate self-awareness, that I am an old, fat, slow white guy. I know that about myself, and I'm comfortable with that. So choosing which game you play is epically important. And oftentimes I use the example, if there was going to be a 100-meter dash between me and Usain Bolt, and I know Usain is no longer competing perhaps the level he did, but I'm going to tell you right now, this is a lead pipe cinch, dead cert. Bet all the money you have on Usain. He's going to win that race 110 times out of 100. He's going to win. Make that race a 200-meter dash. I think you should still bet everything you have on Usain. He's going to beat me. Make it a mile. Pretty sure Usain's going to win, but he might have been so optimized, to use a word we hear a lot of these days, to run 100 meters at a time, that running a mile, he might be gassed before he gets there. And you may, I'll let you in on a secret. I wouldn't beat him in a mile either, but I think there's a chance. There's a chance, and make it a marathon, 26 miles. I think I've introduced an element of doubt that there may be a circumstance which I could compete with Usain Bolt over a period of a marathon. Make it a foot race from Key West, Florida to Seattle, Washington. That's a bet, because it is no longer about pure athleticism and the skills and the horsepower and the IQ points that you bring to the table. It's about will. It's about determination. It's about the proper pacing and stick-to-itiveness that can last for decades. That's my edge. That is our edge. We do have a permanent capital-based business. We have shareholders who've been very loyal and owned it for decades. We have a cadre of long-term shareholders. We have people who are newer to the party and may have a different agenda than what we have. But we know what we can do. And we have a track record of having done it for a long period of time. And I think the values and the formula by which that has been done, both in insurance and non-insurance businesses, has proven itself to be quite durable and quite able to absorb the volatility that the world throws us. And when we look at things in those 5-year kind of time increments, and it's the way in which we measure ourselves and compensate the senior folks, it's been a happy thing for people to own for long periods of time. So with that, I will stop because I know our moments were brief and take your questions. The question coming back from there, any comment on Jana? They published a letter, I guess, a couple of days ago that was a restatement of much of what they said when they first engaged with us back in December of 24. There were many things that they said that I agreed with. We had underperformed in our insurance business, and we've made some substantial changes in management and leadership of our insurance business, and we've gotten to the point where I think we're starting to show some pretty good results from that. They talk about the Markel Ventures set of businesses as a distraction. Actually I believe, again, with the time horizon that we have, the idea of diversification and multiple streams of income coming in provides resilience and durability, and the ability to have cash coming in the door when the insurance business was not doing quite so well, that I think is of great value. But the net of it is, I think they have a different time horizon, that they look at things than what we do, and we've delivered wonderful returns for our shareholders over long periods of time and would like to continue to do so.
So he was talking about some kind of, I just heard about it, some kind of activist campaign, which maybe Tom wants to go into. I want to go somewhere else. First of all, I want to say that I think that comment that I made to you, I actually picked up from Tom Russo. Tom Russo is the first person who said that the United States is the best emerging market. So I need to give credit to Tom Russo for that. I don't know if he's in the room, but and then I think that other than Charlie Munger, I like to know what you're reading. So I'm just going to ask, what are you reading? What is in your bedside stand right now?
Thank you. So I will tell you, in the worst part of COVID, when we were all sitting at home and staring at one another, Susan and I were staring at one another on the couch. And I, like probably many of you in this room, have a copy of War and Peace in my house. And I might have read, I don't know, 3 chapters of it during my teen years, but that was about it. So we were staring at one another and I said, would you like me to read War and Peace aloud to you? She declined that particular offer, but I did pick it up and start reading it. And fortunately, on my travels in the last couple of years, I flew back and forth from Singapore. So with travels like that, you have time to read War and Peace, and I did. And I was very glad I read it. And pop quiz here. Who knows the name of the French general who was attacking Russia at the time? Raise your hands. Everybody know the name of that? You all know. You can admit it. We're among friends here. It's not so. Napoleon. All right. Does anybody know the name of the Russian general?
Kutuzov.
Correct. Well, again,
I've read my War and Peace.
You jumped ahead of the curve. I think if we had had a graded exam, not many people would have gotten that. But he's the one who won, and he did it by strategic withdrawal and letting Napoleon punch himself out. So observing markets where you get out of phase and being in touch with your values and your core principles is incredibly important. And so that book actually reinforced some sense of that. Second book I'll talk about, and 95 books out of 100 I will read rather than listen to, but some I would recommend listening to rather than reading. And one called The Cost of These Dreams by a writer named Wright Thompson. I would recommend listening to it. Wright Thompson is a long-form sports writer, and he talks about characters and people you would know. And I'll skip ahead, start with the prologue, don't skip it over. He talks about the craft of long-form sports writing, which is a worthy essay in and of itself. Chapter number 3 was about the integration of the University of Mississippi. And so many of us who are maybe not quite as keen a student as you know James Meredith in that story, he wrote about it from the point of view of the football team, which had been contending for a national championship and basically got so discombobulated through that process that they lost their way. And Ole Miss, is back in a football powerhouse in the world we live in now, but they spent 30 or 40 years in the wilderness of not being a particularly good football team. And that moment of integration broke them. It disrupted. So read that story. And every single one of those chapters is basically a story written from a different point of view. So the idea of perspective and seeing things from other people's point of view. The older I get, the more I find myself trying desperately to think about what somebody else thinks and how they came to that conclusion and why they wonder that, and to have empathy for the way they see things and not be so proud about my own opinions or own views on things. So I found that book to be a delightful way to just frame the idea of different framings and different perspectives. And it really accelerates your learning and I think your personal skills and how you get along with people when you have that point of view.
I don't want to make this, there we go. Question. Thank you so much.
Tom, this is a philosophical question. I've heard people describe coming to Omaha, hearing Charlie and Warren speak as hearing the gospel. It doesn't change year to year. It's the power of doing nothing. And Adam's slide showed the power of doing nothing compounded over many years. It's very hard to resist the pull to shorten your attention span, your time horizon, if you are someone but look at the value that would have been destroyed if they had been changing their approach year to year. If you want to sort of counteract that and continue to hear the gospel in places, we don't have Charlie anymore. That's a huge loss. Besides maybe the Markel reunion, where are other places where you think people can hear that gospel now?
Well, thanks for the plug on the Markel reunion. May 20th, Richmond, Virginia. Please come. We would love to have you. As Charlie himself talked about books, or conversations with the eminent dead, to use his phrasing. So the idea of reading and thinking about someone who was a hero to you, somebody who got it right, somebody who did something, read about them. read about them. That is very helpful. So I don't know a spot or a particular convention or meeting other than here and what we're trying to do in Richmond. But reading would be the number one kind of option I think that exists to reinforce things.
Thank you.
Go ahead.
Hi, Tom. Benji Sanderson. I think very highly of you, and I'm saying that because I'm going to ask a potentially rude question.
It won't be the first one I've had.
I know. You can have.
Can I ask you one too?
Sure.
Go ahead. Yeah. You first. I'll show you mine.
So speaking of perspective, in my universe, you talked about Markel being a home, and you want shareholders to view it as a home. In my investing universe, you kind of are a very nice home that is next door to two other very nice homes, namely Berkshire and Fairfax. So my rude question is why should I choose Markel over those other two beautiful, potentially cost-effective homes?
I think they're all great companies. They have some unique aspects that make them a little different in the ways that they prosecute their game plan, but they've all done very well, and they've all been very long-term focused and all gone through fallow periods. But anybody who bought them and held on to them, it's I joke, what do you call somebody who bought a slug of Markel, Berkshire, or Fairfax 20 years ago?
Rich.
Bingo. So you're ahead of me. Thank you.
So the last question. Thank you so much.
Sorry about that. Tom, thank you for taking the picture earlier. Michael Hilkens from Treasure Capital. I just want to ask, given the Gayner Partners letter and activist campaign, of course, Markel is known as a family-run company. It's named after the Markel family. You yourself called yourself, I think, the fourth generation of Markel. But there isn't let's say, a long-term big shareholder. So a family-owned company where we had Buffett with Berkshire or Prem with Fairfax. There are some bigger long-term focused quality shareholders, as Larry Cunningham would say, but what would you say to people who might actually try to be successful in such an activist campaign? And what guardrails does Markel have to maybe wander off short-term activists to keep the longer-term focus in place? Thank you.
Well, I think communication, and in fact, I was recently again in a meeting with someone, and this was a Scottish gentleman, and he was telling the story about a particular project he had been working on, and he was the third presenter in this, and the first two presenters had gone before him, and it was a pretty thorny problem that he was working on. And he said at the beginning of his presentation, and I'll do my best not to butcher the Scottish brogue too much, he says, in order for this project to work, the three of us needed to commit to a program of hyper honesty and hyper communication. So what I pledge to you is to be hyper honest and hyper communicative. That is the process which I can control. The outcomes I cannot control. For 39 years, we've acted very honorably as a public company and delivered upon the promises we made, not only to you as our shareholders, but the people who are our customers. That's why people keep doing business to us, to our fellow employees and our associates, and taking care of each other. That is a culturally wonderful way to live life. Charlie Munger talked about his objective, wanting to live in a seamless web of deserved trust. It's a spectacular concept and a spectacular way to behave. What markets do and how people behave, I cannot control that. But I can be hyper honest and hyper communicative and do what we said we would do, keep our do-say ratio approaching 1, and we'll let the chips fall where they may.
Thank you.
Tom, that was amazing. Thank you so much, really. I learned 2 things. First of all, I didn't realize that Tom can do such a spectacular Scottish accent. I think he's not listening, but I think that he should do all his meetings in the future just in a Scottish accent. Tom, I just want to say, you need to listen for a second. I've learned one thing, 2 things actually. The first is you do the most amazing Scottish accent. In the future, we want all of your questions and answers to be in a Scottish accent, please. It's really fantastic. And then I want to say something else. War and Peace is just an amazing book to read. Don't wait to read it because you'll get wiser through doing it. But I've never had that interpretation of Kutuzov and retreating, and I never applied it to investing. I want you to know that another person whose life it's changed is Neil Ferguson, who the historian, who decided to become a historian because he read War and Peace. Anyway, thank you so much. Yeah. And now, where is Eric in the room? So the first time I met Eric was in Kyoto with my family, with a friend. It was an amazing experience. And I have to say that in the letter that I wrote to investors, I failed to attribute 2 points in my life lessons to him. Maybe Tom you'll get into it. But living in the ever-present now is something that I learned from you at that dinner, and I should have attributed it to you. And the other thing is, and I want to repeat it again, I said it at the beginning, being here to see it all unfold, just being here and enjoying what's happening is the purpose of life. And I spent far too long seeking something that was beyond the horizon, and I didn't realize what I have. I now realize what I have, and it's thanks to you. You have an amazing story. He's writing an amazing book. You all need to buy it when it comes out. Welcome. And you know, we're two people alike. We've both had, I think, multiple brain surgeries, so we're a special crowd. So thank you. Yeah.
Thank you, Guy. I'm not good at speaking off the cuff, so I'm going to read today. And like Guy, I've had brain surgery, so if I am a little slow, I just blame it on the missing chunk of my brain. But hopefully, I'll hold it together. I won't be talking about that experience today. I've written about it publicly. You can find my essays on the website. But today, I wanted to talk about actually an experience that I had in Japan shortly after I met up with Guy. Specifically, the story is about a hotel. I think I lost this. That's okay. Should I put it back on? Sure. Thanks. The story is about a specific hotel in Japan. It's called Hoshi Ryokan. It's buried deep in the mountains, and from the outside, there is nothing particularly remarkable about it. It has about 100 rooms, and it costs roughly $200 per night for a suite. But this ryokan holds a very special distinction. It was founded in the year 718 AD. To put that in perspective, Hoshi Ryokan opened its doors 1,000 years before the Declaration of Independence was signed. And it was founded 200 years before the Kingdom of England was established in the year 927 AD. Perhaps even more remarkable is that this business is still operated by the same family, now in the 47th generation of continuous ownership. It is definitively the oldest independently family-run business on earth. To say that this is a resilient business, I think would be the understatement of the century, if not the millennium. The business has survived countless economic cycles, regime changes, succession battles, natural disasters, and even a few more recent snarky Yelp reviews. But it's still here, and you can go there. Over its lifespan, the business has hosted all manners of guests from Japan's royal family, shogun dictators, imperial emperors, samurai warriors, spiritual leaders, and more recently, a decidedly less remarkable visitor, myself. This year, it celebrated its 1,308th birthday. All of that preamble to ask a very simple question. How is this possible? What could possibly explain this incredible outlier of endurance, of family succession? Is it luck? Is it randomness? Is it a specific secret formula of long-term success? That's what I'll be exploring today. So some context. As Guy mentioned, for the last several years, I've been working on a book called Outlast, which comes out next year. It's a book about the world's oldest businesses, along with some of the lessons we can learn from them about long-term thinking. To research this project, I've traveled across multiple continents, sat down with many multi-generational owners. And before becoming an investor, I'm a managing partner at Knightview Capital, I began my career as a business journalist. And I've approached this project the same way that I used to approach investigative stories, boots on the ground, shoe leather reporting. I've always believed, whether in investing or in journalism, you physically have to go to a business to understand it. So I'll admit, I can't possibly explain the precise singular reason this particular business in this particular region of Japan has survived for this long. Like all things in life, the deeper you go, the more complicated it gets. It's messy. But I do have a theory. And the theory boils down to a very simple word: stewardship. Stewardship, as I might define it, is a philosophy of care. It removes the ego from every aspect of life with a total focus on simply serving those around us. Stewardship, I'd argue, is the most important concept in business that rarely gets the examination it deserves. And I think it's very much part of the reason why this company in this particular region has survived for this long. So let me tell you this founding story of this company. It begins in the year 718 AD when a Buddhist monk named Taicho Daishi was traveling through the mountains of what is now Komatsu, Japan, and he came upon a hot spring deep in the hills. The water was warm, and the legend, as has been told over the generations, is that this particular spring had magical healing properties. Now, unlike a gold prospector of the 1800s, or maybe a real estate speculator of today, Taicho did not claim the spring for himself. He did not seek to commercialize it or extract profits from it. Instead, his first action was something different altogether. He gave it away. In the months that followed his discovery of the spring, Taicho adopted a young man to help build a small inn around the flowing water. The only thing he asked for in return was a promise that this man would protect the spring for all future generations, that he would preserve it for weary and sick travelers looking to be healed. He gave the young man a name, Zengoro Hoshi. And every steward since the first Zengoro Hoshi, all 47 of them, across 13 centuries, has lived with a very simple belief. Their business exists to help people in need of healing. It is their family's duty, indeed their moral ambition, to cultivate and maintain the eternal health of the business. This takes patience, restraint, and an utmost respect for the quality of the experience for the guests themselves. Last July, I took a 3-hour train ride from Kyoto to the hotel. I entered through large oak doors, slipped off my shoes, and was handed a wooden key to my room. The hotel today is a sprawling structure of corridors that center around a mossy Japanese garden that has been cultivated for centuries. I got myself settled and soon sat down with the 47th generation, the first woman to lead the business in over 1,300 years. Though her given name is Hisei, when she took over the business, she adopted the formal family name, Zengoro Hoshi. Zengoro explained that the inn has a long-standing saying, quote, monks to emperors, meaning from the poorest to the richest. It's an open-door philosophy that has passed down through the generations and still guides how they think about hospitality. To her, the inn exists to serve everyone, not to maximize her shareholder value or optimize for the highest paying customer. She told me many stories about the traditions her family has kept. One of them stuck out in my head. She told me how every morning for over 50 years, her father would put on a pair of white gloves, walk to a gong in the garden and ring it. Guests who heard the gong would come and sit with him, and he would talk about the inn, about his family, their families. He would talk about nature and about what it means to endure for so long. He liked to say, quote, we learn from water. Water adapts and finds a way. Like any business owner, she also talked about the struggles. And in many ways, Hoshi Ryokan is facing a pretty gnarly downturn. Some investors in this room, myself included, have gone through rough periods. But if you're ever feeling bad about a 3-year stretch of underperformance, consider that Hoshi Ryokan is currently experiencing something like a 30-year downturn. As she explained it, her father made the mistake of taking on too much debt in the 1990s and overexpanded the hotel. Essentially, he levered up at a pretty bad time. Today, there are entire wings of the hotel that are dormant because they can no longer maintain them with integrity. So they've downsized, but they've survived. Perhaps even more devastating was that Zengoro's brother, the designated heir of Hoshi Ryokan, died unexpectedly several years back. In fact, towards the end of our conversation, she admitted to me that she never planned to run the place. Frankly, she didn't want to. But she understood what the business had represented for over 1,000 years, a place to take care of people. She respected the ambition of her parents, her ancestors, and the ambition to make a special place that treated customers well, customers who return season after season. So when her father came to her and said, "It has to be you," she said yes. She understood implicitly this idea of stewardship. Later in the day, we took a walk together through the property. I found it funny. She kept pointing out little flaws here and there to her staff. She'd find a piece of paint missing from a wall and summon a handyman, or she'd point to some towels and ask the manager to refold them. I realized she had a very specific idea of quality for the customer. She was obsessed with getting all the details right. Many times throughout our interview, which was conducted through a translator, I would ask her questions about her ownership of the hotel. But her response was that she didn't even consider herself an owner, even though she technically owned the equity in the business. Instead, she considered herself a caretaker, a person whose job it was to ensure the business survives for the next generation. In many ways, she saw herself like a gardener, someone whose sole role was simply to cultivate the property over time through good seasons and bad. Which leads to a hypothetical question for this room. What if, instead of calling ourselves CEOs, chief investment officers, vice presidents, research analysts, we simply called ourselves caretakers of the businesses we steward? How would our actions change if we embodied this philosophy? What deferred maintenance would we stop deferring? What would it do to the quality of our work? What investments would we make today, knowing that we may never live to see the payoff? It reminds me of a Greek proverb that I love. A society grows great when old men plant trees in whose shade they shall never sit. When I asked Zengoro Hoshi what her goal was for the inn, her response had little to do with growth, scale, expansion, innovation, or anything else you might expect another owner would say. Her response was simple: to hand the business to her nephew in better condition than she inherited it. That was it. Her answer reminded me of a phrase that I had long forgotten, and a phrase that Guy and I talked about at our dinner: tikkun olam. Tikkun olam is a Hebrew expression that translates roughly to repair a broken world. The concept holds that the world, as it exists, is always broken, and that the purpose of a human life, the actual point of being here, is to participate in its healing. It's not to extract from it or to accumulate or even to compound. The purpose is to heal. Tikkun olam is not about grand gestures, but it is an orientation. It is about whether you move through the world as someone who is taking or as someone who is giving back. It strikes me, thinking about this little old hotel, how similar their philosophy is to Tikkun olam. Remember, the monk who founded that spring in 718 AD said, "Build something here so people can be healed." Of course, he did not know that it would become a 1,300-year-old business. I'll close with something a little bit more personal. I have 2 young girls at home. They're both under the age of 5. Many of you have children here as well, maybe grandkids too. When we talk about our kids, we don't talk about building them. We talk about nurturing them. We talk about taking care of them, about giving them the resources and skills to survive so that one day they can live without us. I think businesses are not that different. When you treat a business not as something to be built or even to be grown, but rather instead approach it with care, with duty, with love, you create the conditions for something that can outlast you. Since working on this book, many people have asked me, so what's the secret to longevity? The answer is that I'm still working on it. And I owe the book to my editor at Simon & Schuster in 4 months. So hopefully I have the answer in 4 months. But I will say that I think this is very much the wrong question to ask. Longevity shouldn't be the goal. Longevity is what happens when you stop thinking about longevity altogether. It happens when you focus instead on the quality of what you're doing right now for the people that you serve with everything you have. Before I left the hotel, the 47th generation told me her father had a saying that he repeated to her constantly. Everything is temporary within your hands. You own nothing. You are simply passing it down. That is stewardship. It's a daily act of selfless love. So, my advice, find your hot spring. Find the thing that you believe is worth passing on. Take care of it. And who knows, maybe one day, long after we are all gone, your business will celebrate its 1,309th birthday. Thank you.
Stay there. So you stood up, and so you get to ask the question, but you need to go to the mic. No, we have one question, and I don't want to make it about me. So, well, I will say one thing that, and we have one question. So somebody's got to get to the mic, or else you're going to listen to me talking for a while. So Eric, and I called you Tom for a second because I'm having brain freezes the whole time, you know. That's right. And the last person who spoke was Tom, but I was sitting at a family event of Bryan Lawrence's, and who am I sitting next to? The owner of the sandwich shop. And I felt the same feeling about meeting them. I think it was a couple than I did, as I did about this hotel, which I'm sorry I didn't visit. I hope I'll visit in the future. But Bryan, do you want to talk about how, so I think I just want to say that it doesn't just exist in Japan. It certainly exists in Berkshire Hathaway, and it exists in other small ways. And there we go. So I was rattling on, but now we have our question. Thank you so much. And please introduce yourself as well, because I don't recognize you. And it's the last question, because then we'll go on to Gisela. And I'm sorry, Gisela, you're the person who's standing between us and lunch, but go ahead.
Hello, I'm Alois. I'm an economics student from Switzerland. And so, what a great speech. It's difficult to follow up, but and my question, it came up in my head when I listened to Bill. My question is, if you have a creative investment that you think the expected value is basically 100x what the value of the share is, but it needs 7 million injected into it in order to not go bankrupt. And you're an economics student like me. Yeah. How would you go about, like, do you think it's possible to raise that money, and how would you go about doing it?
I'm not sure I'm going to be able to answer this question, so I'll try to hit it though. So for this project, I've spent a lot of time at businesses that have been around for multiple centuries. In fact, we're working on building out a database of the world's oldest companies around the world. No one's actually endeavored to do this. And so we're getting a lot of input into our own system of thinking about these questions of what creates these incredible outliers of longevity. I think, the question as it's framed is, it's a very left brain logical question. And I would urge you to think more maybe right hemispheric about what are the conditions that must exist within any organization for it to grow. The central metaphor throughout this book is that post-industrial revolution, we've thought of businesses as machines. I increasingly think we need to think of them as gardens. So given enough time and given enough capital, laced with some really thoughtful stewardship, what are the conditions necessary present for it to grow and evolve into something really beautiful? So I don't have a 100x, 100 bagger, lined up, but I think focus on the culture within an organization first, and then start thinking about what those outcomes could look like over time. But it's not about, so many of you're from Switzerland. I've spent a lot of time at the watchmakers. I was in Geneva with Patek and Vacheron, and it's, very often these companies didn't start out making luxury watches. They started making out pieces of steel and wire. So who could have predicted that they would have become luxury watches 200 years ago? So I hope that addressed it.
And I would just want to take a moment to appreciate that you appreciate the value of living in the now, and also the value of the long term. So beautiful to see.
Thank you.
Okay.
Thank you. You can tell why his book is going to be a must read for everybody here. And I think that hearing Eric and having had dinner with him, I mean, 2 of the 8 life lessons I learned from him. And what you were saying, whoever it was who just spoke, there's 2 kinds of time. There's the ever-present now, and there's forever. There's the only, and you said that. It was so beautiful. And so I'm so looking forward to reading your book. Thank you so much. From one brain surgery survivor to another, I now give you the translator and the friend of Warren Buffett's for a long time, longer than I've even known about Warren Buffett, and the woman who has translated. She's gone between the German values and the Omaha values, and she's made them one. How is that as an introduction?
Okay.
Yeah, it's okay. Good. Thank you. I give you Gisela Baur.
Thank you. So they put me between here and lunch, isn't that comfortable. And I'm happy you have me here. I learned a lot already. I learned, for example, that you will cut me off if I talk too long in a very kind but strict manner. So if I'm going to skip some parts, if it doesn't make sense what I say, it's his fault. I title my little speech, What I Learned from Warren Buffett and what I wasn't able to learn from him. And I hope I would have, but I wasn't. Or make it short, Warren and I. It's pretty exactly 30 years now that I first came to Omaha. I was young, I was brave, a bit sassy, a journalist. And during an interview tour in New York, I first heard the name Warren Buffett. And we're talking the 90s. So when I came back to Germany, I tried to find something out, but we didn't have internet. So the only thing I found was one article in German, and it was titled The Odd Guy from Omaha. And the opening credit said, driven purely by a love of numbers, he amasses 1 million after another. So made me even more curious, but it didn't say anything about how he does it. It was just he buys stocks. So you have to understand, we're talking the 90s in Germany. I'm a young financial journalist. I'm crazy about stock market, but I live in a system of family-owned businesses, and savers would go to insurance companies and banks, and stock market was something of an evil, unpredictable, a bad place to be for German people. And so I was fascinated by the stock market, and I tried to find out more about Warren. And of course, there were ways, state library and stuff. And I decided we need him. We need a role model like Warren Buffett in Germany. And I tried to figure out how to reach him. And somebody told me he loves to read. So I started writing. I wrote a letter, and it was long. It was very long. And I told him everything about Germany, the economy system, Europe, the stockholder, the big fraud market in Europe, because people weren't skilled in investing. So fraud market was big. And I did send it to Omaha. And then the 90s again, a fax came back saying, enjoyed very much reading your letter. Why don't you come over to the meeting? The beginning of a long journey. I went to the meeting, and we're talking the 90s. So it was in a smell of sneaker hole somewhere outside of Omaha, some thousand attendees, and Warren would walk in the main entrance and everybody could approach him. I didn't because I missed the moment. So in the evening, there was this football game and I mustered up my courage and decided I'm going to approach him. So I prepared my little speech like, hi, I'm Gisela, I'm the journalist from Germany who did blah, blah. I didn't need it. I just got as far as, hi, I'm Gisela. And he said, oh, Gisela, come over. And right there and then I was given some of the things of the secrets of Warren Buffett's success in one spot. And the first one, of course, and we heard that about Charlie Munger earlier, is his memory. He had questions to numbers in my letter. I didn't even remember I put in. And yeah, we're just talking a photographic memory. We're talking being a computer in a time where nobody has one and the advantage of being a computer. And obviously, that's something I couldn't learn from him. I just can't. The second thing, which really changed things in my life, is what I call his ability to build his very own precious collection of people. I spent a lot of time with him, and I saw him 100 times ending conversations within seconds or minutes, very polite, very nice, but he didn't want to get closer with somebody. And I saw him twice, not ending, but clicking at once with a person, just building a relationship. And that's a bit tricky because one of the two was me. And I can't explain why and how. I only can say it's for lifetime. He decides in 1 second, he lets you in his orbit, in my case, a power orbit, I guess, and you're going to be there forever. So the fact was he wasn't giving interviews, but he gave me one. And he even said we can continue next day in his office. So I went to the office. Of course, I didn't say, no, I don't want to. We went to the office and I had a long interview with him. And as I said, I can't explain why, but it happened. And this interview is unbelievable because it's everything inside I ever learned of Warren Buffett at our first interview. One thing I want to share with you is the sentence, it's really easy or it's really simple. He repeated in that interview for several times. And it took me years and months to find out what that really means. It means he cuts off complexity by saying that's easy. Let's remember a sentence he repeated a lot, like America's best days lie ahead of us. This is a big scissor for all the macro prediction, worries, complexity. You just cut it off with a sentence like that. Great. And it works. I tried it myself. It works. So it's another way to focus on your best skills, cut off the rest. And that's, of course, one thing I really learned. The other thing, and I talked about it, is the insight in human beings and the ability to judge people. And I think that's an incredible factor of the success of Warren Buffett. We can talk numbers, we can calculate, we can whatsoever. We won't get the human factor. And The good news is you can learn to judge people to a certain extent, of course, but you can learn it. And the most important trick here is be curious. And that came to me naturally. I'm a journalist. I'm always curious. I always want to know, who are you? But I try even harder not to tell too much about my success, my profession, my dog, my family. I won't learn anything. I knew everything before. I want to ask questions. I want to know something about you and other people. So that's a really good trick. I think we haven't left the 90s yet, and lunch is waiting. So let me go to a more abstract path if somebody has other plans for tonight. Things I've learned from Warren Buffett. Let's do it that way. The first time I met him, of course, I was fascinated by his financial success. And I was like most of the people in this room probably are fascinated by value investment. It's something taking you at the first love at first sight, and it won't leave you. And and I studied Graham and Charlie Munger's approach to a good, excellent company and stuff. That was my first thing. But after a while, I started to get interested in Berkshire. How does Berkshire work? We're talking one of the biggest companies in the world, and we're talking about costs for personnel and everything else. Some million, ridiculous. How does it work? And we heard that before. It's a web of trust. Charlie Munger explained it to me once as a heartwarming trust. Is the fuel of Berkshire, and trust. It worked. You don't have big fraud cases, scandals or stuff in the past. It worked because we go back to inside of human being. That's the point. And if you have that, it's not only a financial asset. It just makes everything more enjoyable. Trust is really heartwarming. So that was the next thing. I was exploring Berkshire. And then I was exploring the question, how is Warren Buffett able to be such a happy person? I mean, he has money, and many people have money. And we know money adds comfort, power, scope, which is very important. But not everybody is really happy. I know with money, some people are even not really happy, more lonesome than without. But Warren Buffett is one of the happiest people I ever saw. So how does he do it? And we think we know most of the answers: the simple life, the being in Omaha, the people he loves around him, the things he does, stakes bridge in office. So, but if you look closer, it's only half the truth. If you look at Warren Buffett's life, he always had explorations to other fields. Like when he was friend with Catherine Graham, he would explore the big world of the US. He would meet with the elites of politics and economics, and he would travel around and try himself in this field. And later on, he dipped into politics by being advisor for Arnold Schwarzenegger first for California, and then Barack Obama. Later on, he started exploring the world, first with Bill Gates and Item Wertheimer. He traveled. And I found out that he really is digging into things. When we made the film with him, he was so present. He was like, he has no job, but being our protagonist in the film, he had time, he had ideas, he wanted to know everything. He really went into it. And so maybe that's the secret. He's lived his hamburger office and bridge life and made room for extra tours. And the most important thing I try to learn now is it was only possible because he was willing to, you're coming, I see you. 3 more sentences. I was only possible because he was able to give up. He ended all this. So I try to think about, do I do something because I love it or because I used to love it? And end it if the answer is I was used to love it. So one very last thing I didn't learn from Warren Buffett. He's brilliant in speaking and he enjoys it. Not here. I only did it for my precious collection of people, Guy and Chantal.
I'm actually going to let Paul ask the last question because I saw him listening intently to you. So go ahead.
You know, it's when Munger asked you to be the thing, you're like, yes. When Guy asked you to ask the last question, it's like, yes, I'll do that. So I have I'm battling 2 questions. So I'm going to put them both out there. You get to pick. The premise of this whole thing was you thought from a professional journalist perspective that Germany needed a role model like Warren Buffett. So my question then would be, has he become a role model in Germany at any level? That's question number 1. Question number 2 you get to pick from is, how has knowing Warren so well changed your life along the way that you wouldn't have had those exposure if you hadn't taken that trip to Omaha? You get to pick A or B.
A or B?
A and B.
A and B.
A and B. The first answer is quick, so I can do both. Yes, it changed Germany. And Warren once said, if you bring more German shareholders asking questions at the meeting, I don't want to see you here again. So you might recognize there's a big German participation. It changed.
So he did become a role model.
Yeah, he's a hero in Germany now. And the second answer, yeah, did change my professional life for sure. I did a lot of work. I always was keen not being only Mrs. Buffett, doing other things as well because it's, it was too close for me. But it paved the way for many. I made a film. I never learned filmmaking just because I said, I'll bring you Warren Buffett, Charlie Munger, Bill Gates. And everybody said, oh, come in. So yeah.
Thank you.
I have to say that you're a much better speaker than you think you are. You're quiet and you take your time. You are awesome. I now give you the person who's really behind this. I'm just the front man, Chantal.
All right. Thank you very much. I hope you enjoyed it thus far. In the afternoon, after lunch, we have some more fantastic speakers, but I want to invite you to go over and have lunch. We invite you. It's outside, prepared for you. If you can all make your way back in at 1. So it's going to be a yalla quick thing, half an hour. Thank you.
his seat. Who else do we have here? We need to get going. Yeah. So why don't you, Guy Spier? Is it your name's Guy Spier? Could you come up, please? No, please. Could you stand up? Ladies and gentlemen, I want to introduce you to my double. This is he used to be known as Adam Franks, but he's now known as Guy Spier #2. Yeah, he's available for photographs. He's available to sign books. He's a friend. He's a great guy. Yeah, I wanted him on stage, but it's not happening. He needs no introduction. We love him. He lives in Turin. It's a wonderful place. You have a Singaporean wife, and we learn every time. I give you Luca Dellanna. And you should publish your book with Miles Thompson soon.
Thank you so much, Guy. Thank you again for organizing and inviting. Today I will talk about incentives. And let me begin with a quick thought experiment. You're walking down the street, you find a wallet on the ground, no one's around. Do you pocket the money or do you try to return it? If incentives were the main driver, your behavior would depend on how much money is inside the wallet. If it's almost empty, you should return it. And if it's full of cash, you should be more likely to pocket some of the cash. But that is not what we observe in the real world. Some people will return the wallet no matter how much money is inside. And some people will pocket the cash, even if it's little. The point is that incentives matters, but there are plenty of contexts in which culture and habits matter much more. And this is a principle that we see in many aspects, including business. Let's see another example. A sales team is underperforming, a leader introduces a new bonus scheme, but a month later, nothing much has changed. Why? That's because compensation was not the bottleneck. The bottleneck was that people felt awkward during hard calls, were uncomfortable following up, didn't know how to qualify leads well, and so on. The bottleneck was habits, not compensation and not financial incentives. Sales bonuses can motivate those who are already great at selling, but they cannot create great salespeople out of those who lack the right habits. And I'm not saying that you shouldn't incentivize people. You absolutely should, if anything, to attract and retain talent. But incentives alone cannot create high performance where there is none to begin with. If it seems otherwise, it's because of sampling bias. We look at the top performers, we see that they are all well incentivized, and we assume causation. But what happens is that there are many people who are just as well incentivized and yet underperform. So there must be something else going on. And here you see what? Strong incentives coupled with strong habits create strong performance, of course. But strong incentives without good habits, they're more likely to only create gamed metrics or ineffective action. And this is a principle that holds across contexts, including sports. Take Cristiano Ronaldo. Money can influence which team he plays for, whether it's Juventus, Real Madrid, or somewhere else. But money is not why he plays soccer so well. That's determined by his extraordinary habits when it comes to nutrition, training, and playing. Another way of seeing this is Cristiano would play excellent soccer even if he were paid a fraction of what he's paid today. Whereas even if you paid me millions, you couldn't get me to become a great soccer player because I lack the habits for that. This is why it's so important to differentiate between one-off decisions and repeated behavior. Incentives are strong at influencing one-off decisions, but they are weak at influencing repeated behavior, which depends much more strongly on habits. Another way of seeing this, it's incentive shapes intentions, but intentions are not enough to change our habits. After all, if they were enough, everyone will go to the gym, eat well, and never procrastinate. Instead, it is habits that enable intentions. And this is why it's so important to differentiate between incentive problems and habit problems. Because if you have a habit problem, you will not be able to solve it effectively with incentives. And this is a mistake that many policymakers make as well. Take the example of Hungary, who, despite spending almost 5% of their GDP on family formation incentives, they are not successful at increasing fertility rates much. And that's because family formation, it's not an incentive problem, but it's a habits and culture problem. So this is the principle so far. And once you see it, you start noticing it in the most successful businesses. Take Ryanair. They didn't become cost efficient just by incentivizing its managers to cut costs. Many companies already do that, and with worse results. What Ryanair did differently is that they built habits. They got their people to constantly ask what's unnecessary and how can we make this cheaper. Toyota did something similar. They didn't become incredible at quality just by incentivizing their managers. They built mental habits. They got their people to constantly ask whenever they spot a problem, what's the root cause and how can we prevent it from happening ever again? So the point is, performance doesn't come from incentives alone. It comes from repeated patterns of thinking and behavior. It comes from habits. So how do you create them? Common advice focuses on repetition, reminders, and identity. And this can work, but they are slow, energy intensive, and time consuming. What works much faster and more reliably are competence and feedback. Let me give you an example. Imagine you are trying to build a habit of going to the gym, but you do not know how to lift weights properly yet. It's going to be an awkward, uncomfortable, and ineffective experience. And awkward, uncomfortable, and ineffective experiences rarely become habits. Or consider a salesperson who is told to improve results by asking more questions during sales calls. During training, everything seems simple, but then she goes back to her desk, she makes the first call, and she realizes that she doesn't know what questions to ask. So she feels awkward, she speaks with an uncertain voice, she asks weak questions. It cannot go well. And when something doesn't go well and it's uncomfortable, it doesn't become a habit. You don't want to do it again. You don't want to learn how to do it better. And this is why competence is such an important prerequisite for habit formation. And yet, we often skip this step of building competence. We jump straight into action because we think it's going to be faster. It's actually slower. Now, let's go to the second point, feedback. Imagine you're in a meeting and you notice a problem or you spot or you have an idea, so you raise your hand. What happens next? If the feedback is positive, if your manager listens and acknowledges it, you are more likely to raise your hand again next time you spot a problem. But if instead the reaction is negative, if you are ignored, interrupted, or subtly punished, you will not raise your hand again next time you have an idea. And this is how feedback can shape habits by determining which behaviors take root and which ones die early. And finally, Rory Sutherland has this great point about toothpaste. It almost always comes with a mint flavor, even though mint does nothing towards cleaning your teeth. And that's because without mint, brushing teeth will feel like nothing. You will get no feedback, and so why bother doing it? And you will stop after a few days. Instead, mint provides the immediate feedback that gives you the idea that what you did was useful, and so you keep doing it. And this is why it's so important that you give people immediate feedback. And yet managers often forget this. They spot one of their employees doing something well, and they wait until the next one-on-one or quarterly review or performance review. But that is far too late. If you look at it from the point of view of the employee and especially of their unconscious mind, you put effort into something, and then the following day already you're evaluating, did I get any feedback? If not, why should I bother doing it again? And this is why immediate feedback is important. And finally, notice how these two feed into each other. If you take the time to build competence before you start demanding the habit, it will probably go well. You will get positive feedback, and that will kickstart a virtuous cycle where you want to do it again, where you're interested, you're trying to learn more about it, and that leads to habit formation. Whereas if you start without enough confidence, you are more likely to receive negative feedback, and that kills habit formation to begin with. You don't want to do it again, and if you are forced again, you will do it passively, and it doesn't work. Yeah, so this was it from me today, and let me know if you have any questions.
I have so many questions, but we are limited on time, and I've invited Thomas Borcher-Muller to ask the one and only question in the mic. So we will have two. So Thomas, and then you go ahead.
I was just wondering whether
No. You need to introduce yourself first. So, because he's a fellow Schweizer, he doesn't speak with the accent, but he speaks perfect Swiss German.
This is awkward. Hi everyone. I am Swiss. I speak Schweizerdeutsch, which is a entirely useless language, and therefore I learned how to speak English. But it's a real pleasure to be here, and thank you very much to Guy and everybody for organizing this. I was just wondering, is there a perfect example of where habit formation, incentivization, like an organization where you feel like they've nailed it in terms of creating the right balance between those two things?
I'm thinking, so Toyota for me is one of the biggest examples, because, people always talk about, Six Sigma, quality, everything as processes. But for me, the real thing comes in giving repeated tools so that we don't think anymore, do we need to do something? But we just apply it. It starts becoming a habit. Another example comes from my previous employer, which was DuPont, and they really had extremely strong habits when it comes to safety. And I can give you an example. They were so much with a habit of always putting a hand on the handrail, and I was wondering why. And you start seeing that it's multiple reasons. One is because it's a major source of injury. You're on the stairs, you trip, but there is more. Another source of injury is if you are walking down the stairs with a box. Because if you have a box or something in your hands, you don't see the steps, you're more likely to fall. If you need to put a hand on the handrail, you cannot take the stairs with a box. Plus, it keeps you reminding about safety. So that's start of the power of habits. And that was so strong that I remember that once with DuPont, I went visiting our plant in Oviedo. I get down the airport, I get into a taxi, and then the taxi driver says, "You're going to the DuPont plant, right?" And I'm like, "Yes, how do you know?" And "You guys are the only one buckling up on the back seat." So that starts to give you an idea of the power of habits. But one more thing, since you mentioned this, and I think it's super applicable, because I remember my first week in DuPont, the training was like, first week in a new company, you do training, they tell you need to be safe, you need to do those things, but you think, it's just compliance. They're just saying it so they're not getting sued. Who knows if they really believe it? And then a few weeks later, training in Switzerland, in Geneva, where the headquarters was, and one morning there is a bus that, one of those chartered bus, 55 seats, that comes pick us up pick some of us, even some very important people in the company to go to a plant that was half an hour away. And my boss's boss is the first one climbing in the bus, and he notices that there are no seat belts. And he just tells the bus, go back to the depot and bring another bus. So the result was about 17 people blocked in a parking lot for almost 40 minutes. You can imagine the financial cost, the opportunity cost. But in that moment, I understood, oh, they really believe in safety. And it's precisely because it was a costly action that it sent a costly signal, and that's when I truly believed. And so this is also something, when you talk about habit formation, it's super important, consistency. And the moment that you keep practicing the habit, even the one time that it's costly, is the time that you will convince yourself and convince others that the habit is not performative, but we are doing it because we believe that it's worth doing it.
I have a story about you later. Your final question, and introduce yourself as well, because I'm now really curious to see who you are.
Oh yeah, just me, Benji Sanderson from Hermosa Beach, California. Question on what you said about Cristiano Ronaldo, and in other words, attracting someone one time that has incredible habits that then creates value for the team, or in the case of a CEO of business, and applying that to what might be called the Buffett premium for Berkshire. And I'm curious to see what Chris Bloomstran thinks of this later. I was kind of on the side that the Buffett premium was overdone, and that it didn't really exist, and that Greg Abel, his first year being here, will be just as good. But then hearing Steven's firsthand account of why he chose to join the Daily Journal, be directly related to kind of, you might call it the halo effect of Charlie Munger and the aura that brings. I just wonder if you have any thoughts on applying this to companies. How do you get the Cristianos to come when they don't need to play for your team, and how do you attract them?
Yeah, so I want to I'm of course not as big as an expert on I never experienced the people in Berkshire firsthand like some of you did, but what my impression is that I would expect many of the habits to be surviving Warren Buffett and Charlie Munger and so on, precisely because there is such an abundance of anecdotes that are concrete and that are conspicuous, and everyone knows about it. And this is one of the most powerful tools to get habits to survive over time. And that's something that I expect will survive. You mentioned Cristiano Ronaldo. You mentioned one of the benefits is that once you take a person with exceptional habits inside your company, I'm not saying will learn from it, because you can learn from a book, but they will trust. Because when I read a book, I learn from it, but I don't put the same trust in the book in which I will apply it blindfolded. Because I'm like, the book makes sense, but I don't know if it's worth applying. But when you've witnessed with your eyes someone, like I imagine Cristiano Ronaldo, that I suppose, for example, never goes to McDonald's, then maybe you're thinking, maybe it's really worth it not to go to McDonald's if you want to become a soccer player, for example. And so I think that that's one power of getting the people with the habits, not much because you learn from the habit, but because you learn that there is someone you can see and you know that is trusting those habits, and that makes it immediately worth it for you to do the same.
There is so much there, but we have little time. But I would just, in this room, there are very evolved habits, far better than the general population. Luca, thank you so much. I learn every time that you give a presentation. It's wonderful.
Thank you so much, guys.
Thank you. Yeah, I could wax lyrical about a lot of things, but I'm not going to, because I'm standing between you and Tom Russo, and he's got a packet of cereal, the only cereal that's worth eating. I have it still often, and I've learned so much from Tom Russo. I met him for the first time 30 years ago. So Tom, it's great to have you here. Thank you so much for coming.
Thank you.
Oh, hello. Hello. Great. So here's my gift to Guy. Please come back. Oh, it's fine. But anyways, the idea here, first of all,
I'll take the Weetabix off you, no problem.
good. First of all, let me say my name is Tom. I'm from Wisconsin. And I saw that done by Al. That's beautiful. Alec Baldwin at a tennis event, and he was a moderator, and there was sponsored by Hennessy. So there's a very deeply speaking French person presiding over everything. Then finally, Alec was asked to say something. The man Sarge walked by, stopped. He goes, "My name is Alec Baldwin from Massapequa." And so that was quite a illustrious start. But here I'm really here to just tell Guy how much fun it's been together over these almost 40 years now, chasing down ideas. 41.
All my best ideas were yours.
Well, mine were yours too. So they met somewhere over. But thank you. We just had an amazing journey, and Guy is a really deep student of the businesses that we overlapped. Weetabix is an unusual one. It is inedible and loved by the British. And that's probably the pretty universe of things. But the truth is, it is a very traditional thing. I checked the date here, and it turns out NA, not applicable. It doesn't change. I had a particularly grueling investment meeting with an endowment at some point way back, and finally one of the board members showed mercy on me and said to the cluster group that he had the great privilege of studying at Oxford and Cambridge. And he said, over there, this stuff is really popular and it's inedible. So we established that. And he said, but he was going to propose using Weetabix as a oil spill desiccant. What do you think, Guy?
Sacrilege. I eat it almost 3 times a week.
Well, you then have more than enough, at least through the weekend. Yeah. And look, everyone here has their own personal stories of their journey together. And I know I can speak on behalf of mine. It's been just tremendous. And I wish you all the well. You bet.
No, you get to answer questions now if you don't mind.
Okay, it's made out of something nobody knows, and
it's wheat. It's in the name. It's wheat.
Okay.
You know what he doesn't say is that I read an article about Tom in some newspaper, and I saw Weetabix, and I knew Weetabix, and I then is when I discovered the power of brands. But I visited the company, which was an AIM-listed company. And it's now owned by private equity, I think.
It was bought, and boy, did they do well. But
yeah,
we did fine. So
did you visit the company ever?
Yes, I did, and it was.
Yeah. Go ahead.
Let's do it. It's the same phenomenon. It's like a Lionel train set. It's an ancient little clearinghouse for a train that comes in. It's in the town called Burton Latimer. And it's really family controlled, and the patriarch controls the family, and they had a mountain of cash.
Yeah.
And they had this stuff people eat.
And the analysis was very hard. It was a mountain of cash and 4 times earnings. That was it. And when I couldn't meet with the investor relations guy because they didn't have an investor relations guy, but eventually somebody took kindly upon me, and the person who was responsible for customer satisfaction was willing to meet me. And I just saw on the wall the kind of like the family business ethos, basically.
Yeah.
And did I report it back to you, or did I just quietly buy more shares?
No, I knew you went. And I think what happened is after Guy went, they realized that there were 2 of us, and they immediately sold the company.
Yeah, not long after that.
Not long after.
In fact, I've discovered that it was being sold on my honeymoon.
Oh
literally.
my gosh,
yeah.
what a nice gift that would have been. You could have had Weetabix the entire stay.
You need to learn to eat the stuff, it's good for you.
I will do so.
Who wants to ask questions? I want to give the floor to Tom, not to me, and just Chris Rosbach, who knows more about brands probably than
good.
both of us put together.
Good.
Go
Good.
ahead.
Hi, thank you very much. And what a
Thank you.
wonderful conference, Guy. And thank you so much for bringing everybody together.
Yes.
Tom, you represent now for such a long period, really the best of investing in compounding businesses. You're basically Mr. Brand Investing. And I think one of the questions, and I have to declare an interest in investing in these kinds of companies, is what's going on? There's a big, real issue in that these branded goods companies, whether they go from luxury to food to spirits, are struggling.
Yeah.
Is it cyclical? Is it structural? How much does it have to do with the pandemic? How much does it have to do with inflation and what's going on?
Yeah.
And is it different this time?
Is this a 10-minute meeting? That's the sum of many weeks of discussion and review, but it's all of the above. It's all of the above. I mean, yes, the pandemic and the COVID still plague the spirits business. Their working capital is all out of joint because when they had to shut down, they never really caught up, and there's a balance sheet limitation that that's burning through, but it takes time. Nestle had their own idiosyncratic problems of a group that stopped being so self-critical, and when they loosened up the standards, all sorts of mischief took place, both personal and professional and financial, and so they're now redirecting their efforts. Let's see, what was it? Philip Morris, which would have started the conversation way in the back of the pack, just received for the first time approval by the FDA to launch the IQOS brand and the Heat brand in North America. So, I mean, it's happening. In some cases, there's enabling of activity. In some, there's crippling. And I think the spirits one is an interesting one because we all carry our own biases around with us. But for me to buy a tin of Buzzy Ball or something, I think it's called, it's just not going to happen. And I assume this is a Charlie Munger expression that since I believe it'll be, then they're smart and I'm right, that these pre-mixed drinks will lose their cachet. It's been longer this time around, but our investment in Brown-Forman ironically came after a returnable direct beverage collapse that took place in 1986, and caused the company to focus on its business. We find that our ability to communicate with consumers is enhanced by the access through AI, and so we hold forth a lot of excitement about display advertising, and that's sort of underway. But I guess I'm left with the belief, and then what, which is that the products that are perceived to pose a serious deadly threat are not as threatening as they are when you examine them and think about what the other forms of entertainment can offer. But you're absolutely right in terms of all the, you now have direct channels to consumers through e-commerce. You have delivery. You have package changes. So much underway. And at least for as long as we can, it'll continue to have the industry will continue to have Guy and I as expert testimonies.
Actually, Chris, you're a student yourself. What do you make of it? What do you think's going on?
Yeah. Well, I echo a lot of, I think, what you said. And one of the interests is that I have to declare is on the Barron's Roundtable this year, I pitched a lot of these stocks. And some of them have actually bottomed. So you can see with companies like Nestle and Diageo, for example, they're really look like they're at the process of bottoming. With companies like LVMH, for example, or EssilorLuxottica, the leader in frames and eyeglasses, clearly they're not. At least not at this point, although they rebounded obviously from those. So I think it is about those kinds of issues. I think one thing, and that comes from a lot of conversations with managers at these big companies, is
perhaps not some of us, but I think the market really underestimates the impact of the pandemic. The fact that we're even standing here, being able to have this meeting is not something we would have known in March of 2020.
Right.
And the decisions, the keeping people at home, the shift in incomes, the shift in spending, the reopening, the inventory issues, the lack of innovation, the wrong innovation, which Nestle did. All of these issues are things we're dealing with. And I think that when things clear, as they will, and I echo a lot of the positives that have been said today, I think that's when we're going to see they're going to return to growth. So that's certainly the take that I have.
And that's, I sort of leave as the sequel to my observation, which is, and then what? I think you pull forth, and then you're also being greeted with these sharply enabling, we'll see with time whether they're too sharply enabling, but ways that it can have one-to-one marketing and delivery and just innovations that are underway.
Fully agree.
Thank you.
Tom, I'm going to ask the last question before we move. And you actually share, I think, probably a common investment with the next speaker. So Tom was one of the first people in the United States to go to Europe and to examine Europe from a fundamental standpoint. And you know a lot about the luxury goods business. And I would like you just to wax lyrical a little bit about it. What do you think about it right now?
Well, I think it's a very case by case business, and it grouped together as sort of what's going on with luxury, clutters the thinking. Something like Cartier, which has pretty much stayed a steady course, and they sell something that accomplishes what the recipient hopes to have, which is a badge that allows them to tell others who they are by what they wear, what they drink, what they eat, what watch they wear, and it's indispensable if it has the luxury of being called something that they cannot live without. And this isn't a luxury. It is in some ways if you think about the price premium, but think about how you will be received if you come home and give your child, young teenage child, a Toshiba laptop instead of the Apple laptop, which has the big luminescent. You'll really fall deeply flat on your face if you expect that they would accept anything but, because they don't want to be part of that tribe, that group of like-minded consumers. At the heart of what we've got is the hope that you have vital outreach, thoughtfully delivered, that asks people to get up and go buy something.
Yeah. So a follow-up, and then I will say thank you. I think it's you who said, and you've said it many times, that the richer you get, the lesser opportunities you have to distinguish yourself as special. And it goes to the quality of your thinking. I think that originates from you, and please share it with the audience.
Well, there are a couple of funny things that happen when you try to stand out. And there's evidence everywhere. The luxury yachts, ever larger homes, ever larger parcels, the whole bit. So there's a lot of that. But I think the other side of the investigation is there are just lots of people who want to join something that they don't have the means, and so they're extremely loyal to brands that might be mid price, and to that group there's an expression that for those who service the needs or sell into the richest class, they go back and forth on the subway, and they're extremely brand loyal. So, yeah, thank you.
Thank you. It's such a pleasure to have you here. Thank you so much for coming. I'm going to give you a hug. Thank you. Yeah, you didn't see. Do you see the quality of his thought? That quality of thought, in a way, is lacking. He goes to the heart of the issue, and he's been doing it for 30 years. Thank you so much. I can't believe that I go back 30 years with him. It's just crazy. I now give another incredible thinker who I hope I'm not going too far to say he is going to write a book that's not just a letter. he's going to write an actual book, and the man who is maybe going to help him is sitting right behind him, but that's for another day. I give you Chris Bloomstran. You know, and you haven't really hung out with Chris until you're swimming semi-naked in the lake in Zurich, which was what we were doing last summer and which I hope to do this summer again. So
we'll do it indeed.
Yeah. Do you want that? You can actually take it off if you like. This, however you want to do it.
Oh, I'm good standing. First, Guy, thanks for being here. I mean, that you're here with energy and you're upright and you have Chantel and team. I know everybody in the room has been sending you constant energy in your fight, and just keep fighting.
I'm going to say it now. So when I get back to Zurich, I'm going to have a mohawk, okay? You have to convince Chantal to do it. I mean, when do I get to have a mohawk when I don't even have hair on this side, So you're cornered, Chantal. There's no chance. But back to Chris.
So in 15 minutes, I didn't know what I was going to talk about until I arrived, but I think if you've read my letter, I've told a couple of stories. Once this year, one a few years back. But I was trading an exchange over a number of things with Warren, Mr. Buffett, a few years ago, and I just mentioned kind of casually that I'd just done a little math and realized that Berkshire's stock price could decline by 99.3%. And Berkshire would still have outperformed the S&P 500 from when he took over Berkshire Hathaway in 1965. To which Warren responded, this is pretty amazing. Ben Graham would be proud, but let's not test the math. 2 weeks later, 3 weeks later, whatever, I was in Pasadena for Charlie's Wesco meeting. And I mentioned the same stat to Charlie, and he just kind of thought about it for a second, just glared into my soul. And he said, Chris, that's just nothing but simple compound interest. There's nothing impressive about that. So you slink back to your seat. So in my last two letters, I've been working on some math, and I wanted to show the difference between buying stocks at or near a secular peak versus at a secular low, and the differential between earning the Ibbotson 10.5% and over time, how incredible it can be. And so I stumbled into a number. So I'll ask the audience, and if you've read the letter, don't shout out, but on what single day in the history of the United States stock market would it have been the very best single moment to buy the S&P 500? Rhetorically, so June 1, 1932, the S&P had fallen 86.2%. The Dow Jones had fallen 89%. Actually, the Dow traded it as low a month later, but the S&P was $4.40 on the date of the Dow low. It was $4.40. It was $4.40 versus $4.41. Had you bought the S&P at that moment of the cheapest the stock market had ever been, by 1965, you'd compounded at 15.6%, and you'd turned each $100 invested into $10,000, not a 10-bagger, but a 100-bagger, in a little bit shy of a third of a century. Now, who in their right mind would have been willing to give up 99% of their capital to buy a single stock on that day? Well, you know the answer, of course. September 30, 1964 was the end of Berkshire's fiscal year. That's when the Berkshire performance record begins, when Warren took over. And so from 1965 to year-end 2025, each $100 invested in Berkshire would have compounded to $6.1 million at 19.7%. The S&P 500 compounded at 10.5 to $45,000. And that's how you get the math on the 99% decline. But you could have lost 99% twice. You could have gone from $10,000 to $100, and had your money under a mattress would be the equivalent for the first 33 years. And Berkshire would still beat you, even though you were uninvested from the entire market low. So essentially you could have lost all of your money, or 99% of your money, 2 times. And so $100 invested at the market low in 1932 grew to $4.5 million versus the $6.1 million had you waited a third of a century and bought Berkshire. I think Charlie would be impressed with that. I mean, that's just an incredible testament to the performance record of Warren. So I came in at the very end of Ackman, but I got to hear Tom Gayner talk. And so so I decided what I'd talk about is War and Peace, which I've never read it because, as some of you know, I spend the better part of the first 7 weeks of the year trying to write my own version of War and Peace. But the notion of Napoleon and the French army attacking Russia and the Russian army retreating, and as Tom put it, the French punching at the air and exhausting themselves, kind of makes me think about Berkshire. So when you think about Berkshire Hathaway and why it's been successful and what they've done, it would be the purchase of Natural Indemnity in 1967. It would be buying Seas. It would be buying Geico at its lows, American Express at its lows, Washington Post, all of the big investments that wound up being uber successful, compounded for the duration of ownership way ahead of the market. But it was really Warren pivoting at the proper moments and retreating and letting everybody else punch at the air. So if you think about the textile business, closed it in 1985, it went to zero. You think about what Warren did with his partnerships, stopped taking money in 1966, market was expensive, closed it down in 1969 because he had no more good ideas. He said, you can buy Berkshire, you could buy Munis, or you could invest with my friend Bill Ruane. 1998, Berkshire had compounded at 28%. The stock had reflected Berkshire's success compounding capital, traded at 3 times book. Berkshire's investment in Coca-Cola, made in 1988 and 89, had grown from 1.3 billion to 17 billion. Coca-Cola was 50% of the equity portfolio. The equity portfolio was 115% of book value. And Warren had the high-class problem of not only his stock being overvalued, but everything he owned was overvalued. So he buys Gen Re, doubles the size of Berkshire's assets, triples the size of Berkshire's float. Gen Re gets 18% of the shares, and he cuts Coca-Cola from 30% of Berkshire's assets to 14%. Coke is only compounded at 4.5% per year for the next 28 years. So he pivoted. So what we're going to see tomorrow is going to be probably decent improvement in the railroad, decent earnings and improvement in the energy operation. Manufacturing service retail group may have grown at 3 or 4 or 5%, whatever it is, might be down a little bit, but we're going to see what is going to be interpreted as pretty awful insurance results. So Geico, which dramatically has been improved. You went from Geico being behind in telematics and technology, not matching rate and risk. They cut half the headcount, fixed the problem, and 2 years ago, Geico underwrote at an 81% combined. Last year, they wrote at an 85% combined, and the media and observers took it as an awful thing. Well, no, the 3 percentage point decline in the combined ratio, the lack of improvement, decline in profitability, Geico stepped on the gas, spent an extra $1 billion on advertising, and they grew their policies in force by 5%. But they're coming off a period where you're not going to make 85% or 80%. In a normal world, auto industry, Progressive, Geico are going to write at 96, not at 85. So we're going to see a decline. In auto, you write $3 of premium for every dollar of capital. There's too much competition today. No insurance commissioner is going to give an auto insurer a price increase when you're immensely profitable. So loss inflation is going to erode profitability, but more so competition, because there are a lot of people that want market share that are going to compete for the next dollar of premium, and the results are going to decline. In the primary group, specialty insurance, so much capital coming off a very profitable cycle. Berkshire is intentionally writing less business. They're retreating from many of their corporate lines, many of their property lines, many of their casualty lines. Writing less premium volume, they're going to try to maintain profitability. There's a table that Warren included in the 2004 chairman's letter called Portrait of a Disciplined Underwriter. And it showed underwriting premiums by year for a 30-year period of time. Beginning in 1985, Berkshire shrunk premium volume sequentially by a cumulative 80%. They maintained underwriting profitability, albeit at a lower and lower dollar amount. They didn't cut headcount by a full 80%, but they maintained profitability during a period that was brutal for insurance, and all of their competitors hemorrhaged cash. in reinsurance. Berkshire last year wrote 6% of all of the reinsurance premium volume globally, 6%. They have 50% of the capital, which is what allows them to own common stocks. There's too much capacity in reinsurance. So Berkshire in the last 2 years of its $370 billion in cash has sent $100 billion upstream to the holding company. They took capital out of the insurance reserves. Why? There's too much capital. You've got $730 billion of industry capital. If you take Berkshire's underwriting out of the mix, the reinsurance industry went from writing at 86% of premium volume to cap to 94%. The reinsurance industry is writing almost $1 of premium for every dollar of capital, which is crazy. It should be more like 60 cents on the dollar, 50 cents on the dollar. So we've had no storms for the last 2 years, big cat events. Berkshire stopped writing cat. They're in retreat. The top line's shrinking. They're going to write less premium volume. The underwriting earnings, which were $9 billion 2 years ago, were double what they would be in a normal period. They were $7.3 billion last year. They should only be $4.5 billion. So we're going to trend down toward those numbers. It's going to be taken as a bad thing, but it's a wonderful thing because they're doing what they should do, and that's retreating. It's the Russian army retreating in a period where everybody else is punching, and they're going to exhaust themselves, and the industry at a point is going to lose a mountain of capital. This is what you want from a disciplined underwriter, and you're at a point where they're pivoting. And this is why Berkshire is Berkshire, and nobody else does it this way. And it's a wonderful thing because I think the investment community, some are likely to take the results as a bad thing, and if they drive the stock price down, Berkshire gets a chance to buy more shares back at a cheaper price. So that was my unprepared off the cuff.
You heard it here first. Thank you. Who wants to ask a question? There we go.
Chris, nice to see you.
Dave, how are you?
Dave Sather. I'm curious with the War and Peace theme. I hear the public media often talk about how Berkshire's got this boat anchor of $373 billion of cash, and it's because Buffett can't find any good ideas. I'm curious to know your thoughts about, is it because Buffett doesn't have any good ideas, or because it's a secondary version of 1969 all over again, and Buffett is worried about valuation and something far bigger on the horizon?
No, I think it's because Warren even later said he did buy Gen Re, and I think to my mind it was to diversify the Kolk and the expensive stock portfolio, and he did that pretty successfully. And there are reasons why Berkshire's a lot more valuable today than it was. But having not sold Coca-Cola, I think that's why he's trimmed down the Apple position by 80%. So you've had an enormous amount of capital come out of the proceeds of that sale at a 21% tax rate, which would have been a 35% tax rate if he had sold Coca-Cola. That would have been a $5 billion tax liability, which was over 10% of Berkshire's book value, just going to the government in 1998. So the cash sits there as a function of the sale of the Apple. He sold a few other stocks. I don't think it's a market timing call at all. The opportunity set for Berkshire to put money to work is a very small pool. And I think Warren also later admitted that he screwed up 08 and 09. He got $5 billion and $3 billion into GE and into Goldman, the preferreds, and some of the Dow preferreds. But in his investments in common stocks, he didn't do anything. I mean, he bought a few in 2007, didn't do anything in 08, and Berkshire had 14% of their assets as cash, and he should have leaned in. I think Greg gets that, and Greg and Warren would have talked about this. And so Greg's sitting there on $370 billion of cash, 100 of which is required in the insurance operation to underwrite the different lines they have. So there's $270 billion to deploy, plus an ongoing $40 billion. He shouldn't do it today because Berkshire's opportunity set is expensive. But if in the next recession, crisis, pandemic, whatever comes along, and it's, believe me, we've all seen it, it's going to come at whatever point, Greg's obligation, his real task is to spend money and spend it in earnest. And I think Warren endorses that. I think Greg's going to do it, but we can't judge him until that moment comes along. But at some point it's coming.
Hello. Sorry, I've asked too many questions, but you're probably one of two people in the world I can ask this to, so I can't resist. Questions on the chlor-alkali industry and Berkshire capital allocation. So Greg, in his first letter, delineated kind of the reasons why he bought OxyChem, and he gave attributes. You know, it's a industry with a few competitors, and they're focused more on efficiency of. Wow.
Clearly, don't like your question.
Yeah, geez. Efficiency of production over volume and all that, and it seems that the same attributes can be applied to a couple other publicly traded chlor-alkali businesses, but they have not bought shares of those companies. So, besides the obvious, they don't want to own every single asset in the country that produces the same thing. Why do you think they didn't tack on a couple $100 million into those businesses as well to basically monetize the exact same thesis that they had for OxyChem?
Well, I don't. So we own Olin. We bought a whole bunch of it in 19 and bought a whole bunch of it in 2020 when the chlor-alkali world and chemicals were flat on their back. Made a lot of money. Bought it at 12, sold half the position, which was then 15% of our capital at 67. In retrospect, should have sold it all, but we were buying more again at 18. They've bought back a third of their stock. It's an industry that's an oligopoly in North America and Europe. You've only got Olin, Westlake, OxyChem, a couple of European players. Nobody's going to build more capacity in North America and Europe. So it's not a business that for Berkshire will have a reinvestment opportunity. Mid-cycle free cash or mid-cycle cash flow is going to be $1 billion. They paid $10 billion for it, so it's a 10% return, or they essentially bought it at a 10% return. All that money is going to go to Omaha. The assets were incredibly well maintained, so it's just a good business that over the full course of a cycle will throw off capital. And I think there's so much of chlorine and caustic soda and epoxy and some of the downstream being dumped by the Chinese in particular, but some Indians to a lesser degree. The West has sanctioned that in the past, and I think Berkshire, behind the scenes, probably has a better lobbying potential to introduce and try to help implement some sanctions to get rid of some of that oversupply coming out of China. So it's a really good assets, well-maintained assets at a good price.
Thank you.
Last question.
Yeah, okay. I'm Fabian Downhart. I'm an investor from London. And whenever someone asks me about Berkshire, I say, just read your letters. So I just forward them some part of your letters. And I have to admit, I've read not the latest one, but 2 or 3 years ago. And you always had a lot of data also on the economy and on market cycles and kind of like where you think we are in the cycle. And I think we've all seen the graphs of the debt in the US. And, you know, there's a story where Warren always jokes about, oh, macro doesn't matter, like just focus on the cash flows and the companies. And then there's this joke that Druckenmiller said recently, like whenever I go to a value investor conference, I hear everyone talking about cash flows, but 50% is the market, 20% is the industry, and then it's a little bit the company. And so I just wonder what your latest thoughts are on the data of the economy and how you think about that. And because, yeah, you do a lot of work on that as well.
I was terrified when total credit market debt reached 250% of GDP in 2000, wound up after the financial crisis at 350%, which is where it is now. We're running untenable budget deficits, we and the West. I mean, you've got a whole baby boom generation that's now retiring, and we are not going to doge. We're not going to shrink government spending. That's problematic. But I've learned over 35 years investing and 27 or 28 at Semper, it's hard to let the macro enter into your thinking, with the exception of you work off leverage either through deflation or we print more money. And because of that, we've tended to keep balance sheet integrity a heck of a lot higher than we probably would have over time, just because bad things can happen with leverage. And there's enough of it in the system that we don't want to let it seep into the companies that we own.
Chris, thank you so much. I'm now doing the Operation Survivors Club, and so he's another Operation Survivors Club in 1,000 different ways. So thank you so much.
Hips and knees are easy.
Yeah, exactly. Yeah, I would love to try it. Yeah. I wasn't given that choice. So, Lauren, have you gone after your daughter, or are you in the room? There you are. A director of Fairfax. I'm looking forward to hearing what you have to say. You carry a heavy last name. I don't know what it's like to do that. Maybe you can open with that, actually. So thank you for being here.
Thank you all. It's a pleasure to be here with you today. I want to start by thanking Guy for organizing this event and his excellent team that works with him. It's because of you all that we've gotten together and learned from each other over the years, which has been a great gift for everybody in the room. So I'm so pleased to be here with you today. I will start by saying that I do have big shoes to fill. My great uncle was Sir John Templeton. That always makes me nervous. I'm not Sir John. So go ahead and lower your expectations a little bit. But I am going to take you on a little bit of some time travel today. And sometimes in life does give you a second chance. And I'm going to offer a second chance to you all today. So I'm going to talk about Fairfax Financial, and I'm going to frame this conversation entirely through a lens that resonates or should resonate with everybody in the room. What Berkshire Hathaway looked like 30 years ago, before size became its greatest constraint. So Fairfax was built on a similar blueprint. Insurance float as permanent capital, value investing on the asset side, founder control, and a decentralized structure that trusts managers and essentially leaves them alone. The DNA is nearly identical. The key difference is scale. Berkshire is over $1 trillion, at over $1 trillion, simply cannot make a move that meaningfully changes outcomes for shareholders. Fairfax, at roughly $40 billion in market cap, still can. And importantly, the flywheel is now clearly spinning. Since 2017, Fairfax has delivered an 18.6 compound annual growth rate, with float growing at 18%, a $74.9 billion investment portfolio, and a greater than $5 billion annual operating income rate. Now let's look at what Fairfax has actually delivered. Since inception in 1985, book value per share has compounded at 18.7% annually, against its stated target of 15% over the long term. Share price in USD has compounded at 19.5% versus 11.5% for the S&P 500. And Fairfax, if it were ranked among US listed companies, would be ranked 7th out of US listed companies since 1985, putting it in the top 1%, ahead of Berkshire, which ranks 49th. Now, this chart illustrates visually what 4 decades of consistent compounding looks like. As you will see, the line is not smooth. There are difficult years, but the direction and slope are unmistakable. Compounding at this rate for this long is extraordinarily rare. And I would note, I went on the board in 2016. So. To appreciate how elite this track record is, this slide puts into context of every US listed company since 1985, Fairfax sits at the top 1%. And that's not a function of one great decade. It reflects consistent execution across 4 decades. Behind these numbers is a structure and culture that makes them repeatable. Like Berkshire, Fairfax operates through a highly decentralized model. Subsidiaries are run by empowered managers with long tenures and deep ownership cultures. This is not a bureaucracy optimizing for the next quarter. It is a collection of businesses built to compound. The most recent chapter is particularly important. Since 2017, Fairfax has found its stride, resolving the legacy hedging positions that weighed on returns from 2010 to 2016, repositioning the investment portfolio, and delivering an 18.6 compound annual growth rate over 8 years. This is not a story I'm telling you today about potential. The transformation has already happened. And here is where Fairfax stands after a full year in 2025. Gross premiums written of $33.3 billion, a 93% combined ratio, producing $1.8 billion of underwriting profit, consistent even through a catastrophe year. And I will note in these numbers, there's $1.2 billion of catastrophe losses embedded in those numbers. It's amazing what the portfolio could absorb. The total investment portfolio of $74.9 billion generated a 9.3% return in 2025, 7.7% since inception. Float has reached $40.8 billion, growing at 18% since inception. Net earnings were $4.8 billion, and book value per share grew at 20.5% in 2025 alone. And management has been explicit about their forward earnings targets. Over $5 billion in annual operating income, with $2.5 billion from interest and dividends alone, $1.5 billion from underwriting profit, and $1 billion from non-insurance income. That translates to approximately $150 per share in potential earnings before any investment gains. And these are not aspirational numbers. They are anchored in the portfolio and float already on the balance sheet. Now, this is the slide that I find most compelling and one that I wanted to share with you since you are a room full of Berkshire Hathaway shareholders, as I. And it's lining up Fairfax's metrics today against the year Berkshire reached the same milestone. Sorry about that. And that makes this opportunity incredibly vivid. Fairfax's shareholders' equity of $26 billion. Berkshire was there in 1997. Float of $40.8 billion. Berkshire crossed that in 2002. An investment portfolio of $74.9 billion. Berkshire hit that mark in 2002. Gross premiums written of $33.3 billion. Berkshire hit that in 2012. And a market cap of $40 billion. Berkshire hit that in 1996. So why this moment? There are 4 reasons. First, Fairfax is still in the sweet spot of compounding. We're small enough to move, large enough to matter, with share count already reduced from 27.8 million in 2017 to 20.9 million today. Fairfax opportunistically and consistently buys back shares. Second, the earnings power is locked in. $40 billion of float at a 5% yield generates over $2.5 billion in interest and dividends annually before $1 of underwriting profit. And third, hidden value continues to be surfaced from the portfolio. Digit Insurance cost $101 million. It is worth $2 billion today. Eurobank has compounded at 15% annually. The Poseidon and C-SPAN partial sale generated nearly $865 million in pre-tax gains above book this year alone. And fourth, culture and alignment. Prem Watts's family holds a controlling stake. The average holding company executive tenure exceeds 20 years. This is a business that is built to last. So Warren Buffett has said, time is the friend of the wonderful company. Fairfax appears to be exactly that. So thank you, and I hope that you have enjoyed your step back in time. Hopefully this gives you a second opportunity to find an investment as compelling as Berkshire Hathaway was 30 years ago. I've told Guy that we released earnings today. The conference call was this morning. So if you're learning more, if you want to learn more about Fairfax, I suggest you listen to the recording of the earnings call. Because of that, I'm not going to take any detailed questions on Fairfax. As a director, I have to be careful what I say the same day of. I'm happy to close with my favorite story about Warren Buffett if we have a second.
Well, we have one question.
Oh,
so
okay.
At least one question. So if you want to ask another question, say it now, and you'll close with the Warren Buffett story.
Great.
So go ahead.
Great.
I give you not anybody, but Shmuel Goldberg.
Thank you, Guy. Lauren, it's great to see you again. Missed you at ValueX. The question I had is, okay, so now that we place ourselves in, like, let's say Berkshire 30 years ago, how do you think about allocation within a portfolio? I know you might not be able to answer directly, but if you do have a lot of conviction in a stock in general, how do you at Templeton and Phillips think about allocating to something like this?
Well, we have a large position of Fairfax in the portfolio, and we've held it for many years. I think of adding Fairfax, really initially it would have been more about downside protection, but over the years it has generated great returns for us and has been, one of our major holdings and will continue to be. My favorite story about Warren Buffett, if you want to know.
We're going to do one more question.
Okay.
This is a quick one. It's a little bit selfish question. I think you're also on the board of another solar company, if I'm correct.
Yeah.
Could you talk a little bit about that, or is that not allowed?
That's a different type of company. So he's referencing Canadian Solar. It's listed on the NASDAQ. I am on the board of Canadian Solar. Canadian Solar is a solar we have different parts of the business. It's solar manufacturing and energy development projects. And we also have an energy storage division. So a few years ago, we did a secondary listing on the Shanghai Exchange for the manufacturing assets, mostly in China. And the development side of the business is called Recurrent Energy. That is a completely different business than insurance. So it's, it's a volatile business because it's largely dependent on government policy, and you have to adjust very quickly when the rules change, is what I would say. So it's a different business, but that's Canadian Solar in a nutshell, more volatile. For sure. Property casualty insurance is very different than solar business. But my favorite story about Warren Buffett. So, many of you know that my dad introduced me to investments. He put me to bed with stories about the magic of compounding. I was fed a diet of BLTs growing up, Buffett, Lynch, and Templetons. All of these guys are my heroes. My dad is a true value investor. He dresses out of Walmart. Costco would be an expensive purchase for him. He just showed up for his meeting with his estate attorney with all of his documents in a Walmart plastic bag that had been recycled. He is the classic value investor. Okay, he's done well, and he dresses like the classic value investor is what I would say. But one year, this is about 20 years ago, I asked my dad, your birthday's coming up. What can I get you for your birthday? And like every dad, he says, don't spend a penny on me. Don't spend any money on me. You spend too much money, not a penny. So I had to go home and think, what can I get my dad that really matters that costs nothing? So I decided to write Warren Buffett and said, my father's birthday's coming up. Would you mind just calling him and wishing him a happy birthday? So I got onto Bloomberg, and Debbie, his assistant's email was on Bloomberg. So I emailed Debbie and literally forgot about sending this letter because Warren Buffett's not going to do that. I mean, there's no way. And I completely forgot. Well, my dad's birthday rolls around, and guess who calls? Warren Buffett. My dad's at home with the flu. He answers the phone and hangs up on Warren Buffett. I get a message from Debbie that says, I tried to call your father. There was an issue. I'll try to call back later. So I don't even get the message until Warren Buffett had called back. And the second time Dad picks up the phone and Warren Buffett identifies himself, wishes my father a happy birthday. And my dad thought he was joking. He thought it was his brother. So after they went through all of that and they talked for about 10 minutes, the phone call ended and Warren wrote back and said, I talked to your dad. And I replied with, well, thank you so much. I'm so surprised you did that. Please let me know the charity of your choice and I'd love to make a donation in your name. And his reply was very sweet. It was, please do not do that. That would cheapen what I did. Your dad was a perfectly lovely person, and I enjoyed spending 10 minutes with him on his birthday. And I think that's just a great story because hopefully what you've all learned from Guy and from Warren Buffett and your experience here at Berkshire Hathaway, and I would also add the experience at Fairfax because the same type of people attend the event at Fairfax, is that this group is an incredibly humble and kind group. And it has meant a lot for me to be a part of it over the years, for my daughter to be a part of it, even though I had to drag her in here. It's a privilege, and I've enjoyed getting to know you all, and a special thanks to Guy.
Thank you. Lauren, we live off those stories like that you just gave, and it's such a beautiful story. Thank you so much for giving it. And yeah, I'd be on stage with you. I'd have lots of questions, but time is short. So Brandon, you're only stuck between Lauren Templeton and Mohnish Pabrai, so how are you going to do? You're going to do great. That's what you're going to do. I give you Brandon. I'm sorry to say, I can't remember if it's Australia or New Zealand. Australia, there we go. There are people in New Zealand as well, but I don't know how you do it because many of the people that you interview are on the other side of the planet, but somehow you do it. He's a great interviewer, and he really makes you think that you're brilliant, which is pretty special when you're not. I give you Brandon.
Thank you. Thanks, guys. Yeah, so I'm going to be talking about something a little bit different, which is in my realm of, I guess, expertise now, though I always feel like I have imposter syndrome, and that is YouTube. So Guy and Chantal said that I have 10 minutes, which initially was, I was very daunted by the fact that I have to get through a presentation in 10 minutes. And then I realized that's pretty much, talking for 10 minutes at a time is pretty much what I do for a living. So I just want to start by talking about YouTube more generally. I should say my name's Brandon. For those that don't know me, I was in 2017 a physiotherapist or physical therapist, had never really thought much about the stock market before. And in 2026, somehow I have probably the world's largest YouTube channel on value investing, which is weird, but here we are. So how did that happen? I think that setup is kind of an interesting story to talk about why YouTube is such an interesting company, an interesting business, and some of the advantages that it has. So we know that YouTube is one of the big three under Alphabet. People talk a lot about Google Cloud. People are worried about Google itself, and then YouTube can sometimes get a little bit forgotten about. But I'm here to say that YouTube is a very big business, and it's a very unique business, and it does exceptionally well for lots of people like me that kind of start putting their journeys out online, and fast forward a few years, they get a following, and here I am with imposter syndrome talking to you guys. So I guess there's some people kind of know this already, but a lot of people don't. If I was to say, out of the video streaming platforms, which one takes the largest share of TV watch time? You'd probably say Netflix, unless you already know. I'm giving it away. But most people say, oh, of course it's Netflix. But it's not. It's YouTube. So this is from February 2026. Streaming takes up 48% of TV watch time. And then to make up that 48%, Netflix is at 8.4% of watch time, and YouTube comes in really quite comprehensively on top of it at 12.7%. So when we think about funny old YouTube and cat videos and whatnot. We can think about it like this, where it's demanding higher watch time in lounge rooms than Netflix. So it's pretty interesting. So I want to talk about why it works and kind of my experience on the platform as well. So I think what sets it apart and why it's so unique, why it works, is that as opposed to a Netflix where it's high production and not everybody gets to have their own TV show and whatnot, it's very curated. There's a lot of money that goes into every single show. YouTube's just the opposite. Anyone can make anything about a video about anything, you know? So, and that's what makes it so unique and so interesting. So there's over 113, it's about 114 million YouTube channels that are competing for attention. There's 500 hours of new content uploaded per minute. So you think about that, that's pretty mind-boggling. And what you get, because there's so much content, because anyone can make content, is you get so much content that there's highly tailored content to your deepest interests, as opposed to like, oh yeah, I kind of like that show on Netflix. There's enough content on YouTube that whatever your deepest interest is, like say value investing, there's going to be many channels and lots of hours of content that you can watch, so you can find the right person that really hits your interest. And yeah, I've kind of chucked a couple of examples up on screen to show just how crazy niches can be. So slime squishing is a very popular niche on YouTube. Who would have thought? I don't think you'll see a Netflix show dedicated to slime squishing. There's one like, what's that? Best drain unclogging compilation. Or the one I find interesting is the one in the middle, which is a sardine review. So there's people that specialize in sardine reviews. That person's channel is called Canned Fish Files. So you can see this just shows you that clearly these have millions and millions of views. So you can find there's viewership for every single niche out there. It doesn't have to be the mainstream topics. Yeah, there's enough viewers to support every single niche. So Netflix has 325 million paid monthly subscribers, I think, and YouTube has 2.7 billion monthly active users. So there's a lot of viewers that watch YouTube. Honestly, there's not a subscription cost that you have to overcome to be a viewer on YouTube, which definitely helps, but it's still pretty interesting. That's a lot of eyeballs. So I thought I would take you guys behind the curtain as well. So that's why YouTube works as a platform. How it works is also quite interesting. So for those that maybe some of you guys know this already, but for those that don't know, if you click on a YouTube video, you're probably almost always greeted with an ad, right? You wait for the 5-second countdown where you can skip it. Skip. Obviously, advertisers will pay for that ad space. And what's interesting is that the ads that get shown on your videos or on my videos, YouTube doesn't just take it all. They'll cut me in. They'll give me 55% of the ad revenue that they generate. So you can think, maybe this doesn't work so well if you're getting a few views, but if you're starting to get hundreds of thousands or millions of views and you're getting 55% of the ad revenue that YouTube's generating on these videos, it can be quite, it can sustain a business. It can become a business. And we're seeing that. So it's this really interesting effect, which I've not seen any other business really have to this extent. It's a really strong network effect, and it's two kind of overlapping flywheels is how I think about it. You've got the basic one, which is you have more viewers on YouTube, that equals more creators equals even more content, filling even more niches, more, we get deeper dives on random stuff, and that fills needs. And then you get even more viewers, and that keeps going and going and going. But then you have the monetization, which sits on top of that, which kind of fuels, which I guess another flywheel on top, where more viewers attracts more advertisers increases monetization, monetization attracts even more creators. So you get this flywheel effect. And that's what sets it apart. It's that people like me, as I said, I was 2017, I was a physical therapist, and somehow now my business is I make YouTube videos, which is kind of crazy. Yeah, this is more about my story. So as I said, 2017, I was a physical therapist. I learned that I wasn't going to make a whole bunch of money as a physio. So I turned to learning about the stock market, and I was educating myself by just reading lots and lots of books. And my mind was blown that these guys, really famous investors, really, really good investors, they were all kind of doing the same thing. They had the same strategy underpinning the same philosophy, which we all share as the Buffett mentality. And that's how I learned about investing. And I started making YouTube videos about it because I got into it, I was really interested. Yeah, this was my aha moment where I figured all of these famous investors were all doing the same thing. They had the same philosophy, understanding the business, looking for a moat, durable competitive advantage, finding a management team with skill and integrity, and then watching the valuation and waiting for margin of safety. That was the moment after I read all of these books. It's like, it all makes sense. They might have different flavors. Mohnish would say, heads I win, tails I don't lose much. Charlie Munger would talk about margin of safety to account for the natural vicissitudes of life. In reality, they're kind of talking about the same thing. So this is where my channel started. This is just a bit about my journey. I started in 2017. Aussie Wealth Creation was what my channel was called. Thank goodness I did the rebrand. So my channel now is called New Money. It's much better for international appeal, So New Money is my channel. In 2020, I was able to leave my job as a physiotherapist to pursue YouTube full time. This is what my channel looks like. And my content is pretty much around 4 pillars: value investing. I talk about super investors and the 13F filings. I talk about economic events, and I talk about occasionally company deep dives. And the reason I put that up there is not to, boast or talk about, look at me, what I'm doing. It's to say that this, to most people, I know we're a select group, but to most people, you wouldn't say that's the most thrilling of topics or the most thrilling or Mr. Beast style YouTube videos out there. But somehow, because of the things I was talking about before with YouTube, this is what's happened. So over the lifetime of the channel, we've done over 100 million views. We've added over 1 million subscribers. And the monetization thing is what I find really interesting. Just through that, this is just YouTube AdSense revenue. This is not brand partnerships. This is not businesses that I've created to funnel into the YouTube videos. None of that. This is just the ads that are shown on the YouTube videos. It's generated our channel about 1.4 million since 2017, which, is, you can think maybe as a big business, that's nothing, but as one person just making YouTube videos, that's pretty remarkable. And you can see why so many people now are, instead of wanting to be pro sports athletes, they say they want to be a YouTuber, So it's quite interesting. And YouTube is the only platform where this inbuilt monetization engine really works effectively. So many people turn to YouTube and make long form videos to capture this, to capture that kind of revenue and to build their own businesses off the back of it. Yeah, so the point of all this, it's not just to say, look at me, it's to say, YouTube didn't just create a media platform, they really created a new economic model for niche interest and niche expertise. You no longer need mass appeal, you don't need a Netflix, you really just need to be, you need to be useful or interesting to the right people. And that's kind of what I found by talking about investing. The internet is now big enough to support almost any obsession. It's a win-win-win. The creators win, the viewers win, and because both of those win, YouTube wins as well. Yeah, and that kind of leads me to the end of the presentation. I just wanted to say, like, one of the crazy opportunities that I've now had on the back of building this YouTube business is I've been able to write a book, which I'm actually kind of in Omaha to launch at the moment. So if you wanted to pre-order the book and kind of learn more about, I call it my education of a value investor. I wanted to call the book that, but apparently it's taken. Some dude's already written a book called that. What was I don't know. But yeah, if you wanted to pre-order, I'd really appreciate it. And the other thing I would also like to do is we coordinated this so we didn't have overlap with ValueX. But after ValueX finishes, if you wanted to come across to the Diamond Room, Omaha, I'd love to invite you guys to come to our book launch event. I'm going to be there. Phil Town's going to be there, 3-time New York Times bestselling author. Divya Narendra is going to be there. We're going to be chatting to him about his story with Facebook and how he and the Winklevoss twins got screwed over by Mark Zuckerberg. If you guys have seen The Social Network, you guys seen that movie? Yeah. So Divya is portrayed in that movie. So I'm going to chat to Divya. Hamish Hodder's going to be there. I'm going to be there. Matt Peterson's going to be there. Nate O'Brien's going to be there. So there's lots of creators going to be there as well. So if you would like to, I would definitely invite you guys to join us after ValueX. It's a short walk from here, so we made it very close. But with that said, that's the presentation. Thanks very much for listening, guys. I appreciate it. Thanks.
So, where's Chantal? So when I was taking money in, I'm not doing that anymore. Chantal would ask the question, where did you find out about us? And they kept coming back with YouTube. And so it was Chantal who forced me onto YouTube. She forced me to take invitations from people like you. My point is that it's a discovery mechanism also for people who are trying to sell their ideas. I did a podcast with Luca Dellanna, and then many people found him. So here's my question. How many people here, by the way, where's Hamish?
Where is he? He's up the back, in the back corner there.
I've never met you in real life. We've done this podcast together.
It's going to be a very
so much fun.
long handshake.
Yeah, so, but how many people in this room should become creators themselves? And maybe you can just talk about that for a little bit.
Sure. I mean, I'm biased, but I think if you have a business, if you have a fund, if you have anything where you would like to get more clients, more investors, I think you should put organic social media strategy at the core of what you do. Organic as in not paid. So my business partner, Ed, will not like me for saying this because he's nicer to paid ads than I am. With paid advertising, you pay money to force your way in front of people that don't really want to see you. So you're just running numbers and you're hoping that 1 in 100 will click your website or something. With what we do, we actually work with clients to help them get these results. So if you're interested, you can talk to me after. But what the idea is that instead of forcing your way in front of people, just make content that would resonate with your end customer or your, someone that might be interested in your fund. Do really good packaging, titles and thumbnails, and hit their core interests. So hit what these people are going to want to search on YouTube, and then people will funnel through your YouTube videos into your fund or into your business or anything like that.
Does somebody have a question? Because I have another. I'm going to put. So Divya, you're going to ask a question, and that's it. I'm going to say one thing that I learned from Jeremy Stickney. Is Jeremy in the audience?
Oh, Jeremy.
Because I learned so much from him. Learn this. If your content sucks, it's okay because nobody will click on it and nobody will watch it. So it doesn't matter if you have a lot of bad stuff out there. It's just fine. And there's a famous kind of like rock star who said this: have the courage to suck. And if you put content out, I mean, maybe you can talk about that rather than me lecturing about something I know nothing about. And then we'll go to Divya's question. And you're only standing, Divya, between you and Mohnish Pabrai, but go ahead.
Yeah, I think just starting is key. A lot of people are scared that, it won't be received well. They don't know what they're going to look like on camera, but you can just start. And I would just think my biggest tip would be, if you're doing it for a commercial reason, if you're trying to get investors or clients or whatever, just reverse engineer what your person is asking. Like, what are the questions that they have, and make YouTube videos that specifically answer those questions, so that when they inevitably look it up on the second biggest search engine behind Google, that they will find your videos.
It's a great last. No, you need to get a mic here.
There you go. I'll come down with you, mate.
So as the world gets more and more ADD, I want to understand monetization a little better. There's a big transition to shorts. So talk about monetizations vis-a-vis YouTube shorts, reels versus the long form content, which you do a great job with, I have to say.
But no, you have to get back on stage. Thank you.
Shorts, they suck. You won't make any money doing shorts. The way I think about short form, well, that's not true. People on Instagram and TikTok, they make a lot of money doing that, but they do it through brand partnerships. So that's where the money is made. The inbuilt monetization engine is really on long form YouTube videos. Shorts, there is that inbuilt monetization engine, but we've heard on earnings calls just how hard it is to monetize and charge a lot for the ad space on short form content, because it's just not very effective. So from a creator's perspective, I'm not going to make a lot of money by making shorts. It's good for discoverability, to just get your face in front of people in a small way frequently. But then in terms of actually making decent money off of the AdSense, it's just YouTube long form.
Thank you so much.
No worries. Thanks, guys. Appreciate it. Thank you.
Thank you.
Thanks,
guys. Sometimes you just have to get off the stage and let the star perform, and that's the case with Mohnish. So I give you Mohnish Pabrai. I have nothing to add.
So I've seen Guy a few times over the year, and this is the best he's looking. And it's really awesome.
We're going to style here for a second, so I need to do this. So this supposedly will come back, but I think that I want the mohawk down the middle, and I leave this side, and I'm fine with it. The barber's fine with it. You just have to convince that lady. So please do your best. Thank you.
So it's really wonderful to see Guy looking and feeling as good as he is feeling right now. And one of my mental models is that your deepest desire is your destiny, and we know what Guy's deepest desire is. And if you don't have a deepest desire, then you can make that your deepest desire. But it's wonderful to see this event, and I'd like to thank Guy for putting it together so selflessly. So thank you, Guy. So I wanted to just spend the time talking about what you guys want to talk about. So we can go straight to questions.
Hi, thanks for taking my question. Before I get to the question, Guy, one way to convince Chantal is you could clone Mohnish's hairstyle. You'll have to do the mustache too. Okay, Mohnish, since we have you and we have been talking all day about US and AI and more US, I'm very curious to hear your views about international investing in a world where AI seems to be the biggest divide kind of between haves and have-nots.
Well, so very early days, very embryonic in terms of what's going on with AI. So from an investing point of view, as long as humans are involved in the process, we will vacillate between fear and greed. And as long as we vacillate between fear and greed, there's opportunity, and we can do well as investors. At some point, it's likely that there's a lot more AI influence in the space, and the fear and greed vacillations become much lower. And I don't know when that happens, but I have not seen so far any movement in that direction that is telling me it's happening next week or next month or in 3 years or something. And so it might be a while till we see that. The have and have nots, I don't think that's going to be a divide with AI. I think that what I find, if I look at a place like India, in the remotest areas, there's internet access, good mobile access, and at a very low cost. And so it's actually been a big equalizer in terms of helping the have-nots move into towards the middle class and so on. So that's on that front, I see it more than enabler rather than anything problematic.
May I ask a follow-up if that's okay? Actually, India is a great example, and not because I'm an India fund manager, but also because that's where like 1.5 people, 1.5 billion people live. So it's important for humanity. Access is yes, but monetizing and the whole story about 1 billion people moving up the middle class, does that come in jeopardy? Does the fact that having people is no longer a demographic dividend, it's a liability? From an economic perspective, how does a country that does not have foundational models, how does that country fare 5 years from now, 10 years from now?
Yeah, I actually wrote about this last year in Dakshina's annual report. We had a girl in our program who basically qualified to get medical coaching from us, and she eventually got to med school. But her father, she came to a very remote village in North India. Father got paralyzed when she was about 11 years old, and family lost all possible livelihood, which is already very meager. And the mother had some very basic sewing skills with a sewing machine, and she taught our scholars, 2 elder sisters, whatever skills she had to make clothes. And then the 2 sisters went on YouTube and they became ace tailors, just based on what the mother taught them and what YouTube taught them. And with that skill set, they started to, in their home, make custom clothes for local people in the village for weddings and whatever. And they did well enough. And one of the problems they had, they only had 1 machine and 2 of them. So one of their uncles got them set up with a second machine and actually a small shop because they were bringing in enough money to do that. And the 2 of them actually were able to sustain the family. Muskan, which is the girl who was with us, helped them wherever she could. And then, when sometimes the sewing machine would break down and they had no way. So YouTube taught them how to fix the sewing machine too. So, the specified, very narrow content. I mean, that's an example where the bandwidth cost was extremely low. The videos were free. They were able to really pick up everything they wanted. And it led to their sister getting to Dakshina, and then she got to med school. And of course, now I think in about 5 years, the family will be in a different place because she'll be a doctor and all that. So I think that in India, we have this term, and I don't know the exact translation. Maybe you can translate. It's called jugaad. What is the exact English translation of jugaad?
Like make do?
Yeah. So it's kind of like, coming up with a solution, which is not a traditional solution. But basically, I think that that's an example of how technology becomes such an enabler in a manner where, the government is not in the picture, the infrastructure is not in the picture, nothing's in the picture, and it still works. And so I'm optimistic about that. So, and we've seen it firsthand, actually.
Yeah.
Thank
we
you.
need to. So before you go, we're going to go to you, but you're going to introduce yourself as well.
Okay. Hello, I'm Alois. I'm from Switzerland. And
Grüezi
huh? Grüezi wohl. Okay. So Mohnish, you're one of my heroes. So cool to have you here. So I would describe you like a bit of a cowboy. You do stuff like no one else does. So how do you nurture that quality in yourself?
I'm just putting one foot in front of the other, so we just kind of make it up as we go along. There's no grand plan. And, but I think for me, the main, I would say beacon, and it's a very important beacon, is the pursuit of passion. So it's difficult for us as humans to sometimes know what our calling is and what our passion is, but it's worth spending the time to try to figure it out. And it's not easy to figure it out. So one way you could try to figure it out is wear a lot of different gloves and see which one fits. But you have to, or introduce randomness in your life. And through that, something could lead to something. But basically, if you spend all your time doing what you love doing, you're going to do it very well. And you're going to have a great time.
Go ahead. Thank you.
Hi. You recently talked that you bought some constellation. the current valuation. Can you talk a little bit
I'm
about
sorry.
Constellation Software?
Oh, yeah, sure.
Can you talk a little bit about how you see the situation of the company right now?
But not after you introduce yourself. Yeah.
I'm Gilad from Israel.
All right. So I think Constellation is, part of the sell-off in a lot of different stocks in the software space, the SaaS space, because people think, with AI, you just kind of don't need these companies. You don't need Adobe. You don't need a lot of different companies. And I actually think the opposite is true, in the sense that I think the incumbents get a tailwind, and new entrants probably face similar barriers as they did in the past. I don't think it really helps them that much. So incumbents like Constellation may see their costs go down somewhat. Now, it won't go down a lot because people think that that's the code generation is most of the cost, but that's not most of the cost of writing and selling software. So they may get some reductions, or they may be able to increase feature sets, may become broader. But in either case, I don't think they get challenged because a lot of this is to do with business rules and user experience and all that, which takes a long time to get right. And so Constellation may also get some advantage on the acquisition side, in the sense that there may be some founders who may be nervous about what AI does, and so they may be more willing to do a transaction. And company like Constellation is a little bit better placed to look at that. So I actually think there's some opportunity in the space because of some irrational perspectives. So we'll see.
Thank you.
And plus, I think Mark Leonard, a very unique person, amazing leader, and he's built an engine that I have not seen built by any other non-Mark Leonard company, in the sense that I think in the US they've got maybe close to 100,000 vertical software companies in their database, and they touch these companies at least twice a year. At least twice a year by calling them, and at least twice a year by emailing them. And they're just saying what Warren says, which is, if you ever decide to do something, think of us. And so if you think about 100,000 software companies, and you think about everyone being between the age of 40 and 80, for example, who's a founder, about 2.5% of them are just going to be gone, either retired or whatever, every year. And so that's 2,500 companies right there. Plus there's others who want to retire and other things going on. So I think they've got very robust pipeline and they can be very choosy. And humans are very poor cloners. And so we're not going to see anyone else clone it, even though they should.
They're trying in Europe with chapters.
Yeah, but I'm just saying those are Leonard companies, even Topicus and so on, so.
Thank you, Gilad. And now you know that you have to introduce yourself, so go ahead.
Yes, Andrea Vacchino, investment professional from Italy. So thanks, Guy Spier and Aquamarine team for organizing this event. The first for me, really impressive. So my question is about active management. You represent really a successful case of one-man shop. You have a team, but I guess you are the key decision maker. In the current framework where AI and the information flow will be different, so analysis will be done differently, you think is going more or less likely that those single-man shop are going to outperform against a larger organization?
Well, I think we don't know too many committees who won Nobel Prizes, so I think this is very much a lone pursuit for the most part. It's not a team sport. And so I get a lot of help from a couple of guys on my team. And but I don't think this is the trend is that the single guy is at a disadvantage. In fact, one of the advantages a smaller team and a single guy or girl has is that they are able to focus on the smallest opportunities. And because generally speaking, they'll have less assets to manage. And, Greenblatt pointed out that, all of us start out at the bottom looking at the smallest opportunities, and the successful ones have to move up because the assets increase, which leaves the bottom fertile ground for the next generation to come in. So even when you have different tools and different things take place, that bottom continuously is getting kind of replanted without having the old people there and so on. So I think that it's almost evergreen that if you are starting out and looking at the nooks and crannies, those will always have some promise.
It helps you if you have 180 IQ as well, and he's not aware of that. But so you need to take it with a pinch of salt. But thank you for your question.
Thank you.
Hi, Mohnish. I'm Fabian from London. I think in the industries I'm looking at, the situation is actually that China's companies are have very high market share and are dominant. So like solar batteries, EVs, and so on. So if you just look at market share, the Chinese are really dominating. And in some way, there are things I will never know about Chinese companies, right? So how do you think about China? How would you deal with it? And I know that maybe Charlie and Warren also had different opinions on that. And I know you've been quite close with Charlie. I don't know if they argued about China, but I was curious if you have any ideas on that topic, and also how you deal with that not knowing for different countries, because I know you diversify between different countries out here, but you have these kind of unknowns as well in your portfolio. So I was just wondering how you deal with that as well.
Yeah, so I actually don't start top down. I never start top down. So it's actually the wrong way for me to think about it. And so I don't start out saying I want to invest in China. It always, to me, starts with the business and, where it's based and all that comes in later. And I would say that most of China and most of the companies in China would just go in the too hard pile. I just wouldn't have any kind of edge or anything like that, which would help me get there. So in general, most things I look at are either outside circle of competence, or they're too hard, or I don't understand them. So it's a very small sliver of things that kind of cross my radar, which I say, oh, I can understand this, or this makes sense, or whatever else, and then we can look at that. So usually, like one of the models I use is that if you cannot explain your thesis to a 10-year-old in about 4 sentences, it's a pass. And so if anything is not does not have the level of clarity for me to do that, then it's a pass. And so most things will not get to that level of clarity for me. And so, but the good news is there's like 50,000 stocks around the world, and we need to find like 2 of them in a year. And so there's not been a problem so far.
So we have, after this one, 2 more questions. Please, nobody else stand up because we have other things to do as well. So you're going to go, and then you're going to go, and then, well, I don't know your names, but you're going to tell me your names so I will try to remember them. So, and where you're from, and a little bit about you. Go ahead.
Yeah, hi, my name is Anand. I'm originally from New Delhi, but now I live in Vancouver. Hi, Mohnish. I think I'm having one of the most exciting days of my life today, meeting you and Guy in person. So, and I mean, the talk in the morning was wonderful. So to the audience, I attended a talk this morning at University of Nebraska, given by Mohnish on mental models. So in case you guys, whenever it is uploaded online, I would highly recommend taking a look at the talk. I think it was amazing. And Mohnish, the question to you is regarding leverage. So there is, with dollar being highly leveraged, do you think, and with a prospect of dollar debasement, do you think there is a real risk for equity investors? And if so, how should long-term equity investors should think about it? Or like with the recent rise in gold, do you think there's actually a seismic shift in terms of, or a shift to something like gold is likely to happen in the future?
Yeah. So if we look at a company like, let's take a company like Coca-Cola, and let's say we have global nuclear war and 99% of us are gone. And Coke's, the 1% who are left, they'll be willing to trade, 10, 15 minutes of their labor for a can of Coke. And they'll be willing to do that all day long. And so eventually from the ashes, there will be, a bottling plant created and a concentrate plant created, and Coke will kind of come back and whatever else. And so it doesn't really matter what the currency is. Coke has value regardless of the currency, right? Regardless of what happens to the dollar or anything else. It has value because we are willing to trade a certain percentage of our labor for the can of Coke. And so I think it's not worth wasting brain cells on these very difficult to answer questions. I think it's better to put the brain cells on investing in businesses that we think have some resilience and that can be around and that have got some moats around them. And you could even maybe think about what happens to the business in the case of, so currency is not necessarily going to negatively impact a business, no matter what happens to the currency. I've got more than 70% of my portfolio in Turkey. The currency has gone down by more than 90% in the period I've invested. In dollar terms, we've had spectacular returns. And so the currency has been irrelevant, basically. And so I don't really spend a lot of time trying to answer questions that are difficult to answer on, what happens with this and that. But as long as if core businesses are great, I think they'll transcend a lot of these things.
Thank you very much, Mohnish.
Yeah.
Hi, Mohnish. My name is Shahar. I travel here from Israel. I'm a fund manager. We've been following your work closely there, especially your commitment to Dakshana. I'd love to hear how the foundation is doing lately and what's on the horizon for it. Also, since you have such a close bond with Charlie Munger, I was wondering if you could share a story about him, perhaps something personal or less known that we shouldn't find in the books or YouTube videos. Thank you.
Okay. Well, Dakshana has worked out far better than I would ever thought, ever dreamt. And now it's been 19 years since we started, and most of our team is alums. So our CEO is not an alum, but everyone below him, almost everyone below him is an alum. Most of our faculty is alums, and these people have far more passion for it than I do. And so it's actually in extremely good shape. I actually get really humbled when I meet them because they are just so driven. And so that's worked out very well. And I don't know whether we have enough time for Munger story. We have 5 minutes?
Yeah, I'm under Chantal's orders.
Because, you guys are past the time that you paid for the room by 11 minutes.
I think we need a Munger story. So we need a Munger story.
So it's a somewhat X-rated Munger story.
Aren't they all?
So, Munger's assistant, Dorothy, she told me once, I'd mentioned that when I would meet Charlie, every second sentence he said to me had the F word. And so she comes to me and said, Mohnish, I've known Mr. Munger for all these decades. That is not how he speaks. I said, Dorothy, that is not how he speaks to you. But I can assure you that is how he speaks to me. So one time I was at the LA Country Club, and I used to meet Charlie and Rick Gurin probably every like 5-6 weeks or 7 weeks or something for an afternoon of bridge. Friday afternoon, Charlie would play bridge, and they had a regular group, but I told them when one of the old guys can't get out of bed, just call me. And so I was there like a standby backup, be the fourth or whatever. So we used to have lunch before the bridge game started. So I got to the LA Country Club, and we were still waiting for a couple of guys to show up, but it was just me, Charlie, and Rick. And so I was sitting across from the two of them, and I told them, I said, you guys think this is just some lunch before some bridge game, but this is a historic event for me. This is a big, I know you guys think this is no big deal and whatever else. This is a very big deal. Okay. And they said, yeah, whatever, they didn't care. So I said, can you tell me about the time when you guys were doing your deals together in the 60s and 70s? An interesting deal where, you were shooting fish in the barrel after the water's been run out, right? So Rick Goren looks at Charlie and says, tell him about the blonde, okay? And so Charlie then takes over, and he says that, so there was this kind of maverick entrepreneur in California, and he had come up with an adhesive, kind of a fluid that you could pour into your engine, and it would seal any engine leak. And so he had kind of invented this thing. Now, the guy was kind of a nutcase in terms of finances. They were all upside down. But the way he built sales was he used to go to auto repair shops in Southern California with his gun, and he'd shoot a hole in his engine with his gun. Then he'd pour the liquid. Then he'd show them that there's nothing leaking. And that's how he built sales. Okay. So he drops dead unexpectedly, relatively young, like in his late 50s or whatever. And the business is all upside down. They got a lot of debt and such, because he was just not very good at some of the other things. And so Rick Goren sees in the obituaries that this guy is dead and that there's this business. And so they do the research and they find that there's a lot of bank debt, and they buy the bank debt at 20 cents on the dollar, because the banks, it's all non-performing. But the guy, his wife is technically the owner of the business, because it passes to her. And they didn't want to take the business without making some payment to her, even though they weren't really obligated. So what this maverick entrepreneur had done is he had a mistress who his wife knew nothing about, who he made the executor of his will. And then he passed the business to his wife. So the grieving widow, first she's grieving that her husband has passed away, and then she finds out about the blonde nurse, and then Charlie says the blonde nurse was very well endowed. Okay. And so he said that the two women were very upset with each other. The blonde nurse felt that the wife never took care of him, which is why he was with her. And the wife said, the whole thing is ridiculous. The guy, he was cheating on me. I didn't even know, and all that. And Charlie needs the two women to cooperate just enough so that they will sign things over and they can get the business. And the guy had borrowed $80,000 from the wife's aunt. And so Charlie talked to the wife and said, look, you need to cooperate, because your aunt, she can get some money from this. And otherwise, there's nothing coming. It's all locked. And so he pacified the wife. And then he had arranged a meeting at the California club to have lunch with the blonde nurse, right? And the California club is a very blue-blooded 100-year-old institution. That's where I met Charlie first time for lunch, ornate, lunchroom and all that. So he's meeting her there. She comes straight from work, and she's in her nurse's uniform, and it's 3 sizes too small. Okay. And in Mr. Dignified Munger's words, there were tits everywhere. Okay. So he never told Dorothy the story, so Dorothy doesn't know. And so all the other members of the club are watching Mr. Munger, their distinguished member, having lunch with this porn star because they just thought she's a porn star. It couldn't be anything else. And they couldn't understand what the hell is going on here, like, Mr. Munger and this and that. But anyway, Charlie said, I pacified her enough. We got the deal done. And then eventually that company actually went to Berkshire Hathaway, and later they sold it. But so that's what they told me at that lunch then.
Great story. So I don't know how you follow this, but you're going to try and answer a question that tops that. I don't know how you're going to do it, but I give you somebody unnamed for the last question of the day.
Hi, I'm Satish. I'm from Charlotte, North Carolina. First of all, thanks to Guy and your team for organizing this event. Mohnish, I have actually a couple things to say. So first one, I'm a huge fan of yours. I've actually watched almost every video of you on YouTube, and then I've always learned something new whenever I watch your video, right? So recently in 2025, I did watch a video of your podcast on Diary of a CEO, Stephen Bartlett, and I've learned a lot of things in that episode. And one thing was specifically when you said, I believe I'm paraphrasing it, but you said, you were trying to get something, and then you kept trying until you got what you wanted, right? So what I thought, okay, I'm a podcast host. For somebody who doesn't know, I'm a podcast host, and at that time I thought, okay, I wanted to have Mohnish on my podcast. So I did reach out to you, as I thought, okay, I'll just keep reaching out. I'll just like how you cloned Warren Buffett. I thought I'll clone that idea of yours. I'll start, bugging you so that one day you'll say, hey, enough of your emails and I'll come on your podcast, right? So, and I got a reply from your team saying that you're going to pass this time, but just so you know, I'm going to keep trying until you're going to be a guest on my podcast.
So there is one of the mental models I talked about today and actually even earlier was that your deepest desire is your destiny. So if you really want something to happen, it will happen.
Yep.
So you should keep trying.
Yes. Thank you. And
good job.
I have actually said the second thing to say.
I want to invite Chantal, Mariana, and David onto the stage. I would say one thing before you get your last word is you need to vary your approach as well. So, but go ahead, your last comment.
My last, maybe this is a question actually. So like I said, I've always watched almost all of your videos on YouTube. So one thing very common is you always talk about the power of compounding, right? The power of compounding and how it applies to money and stuff. So actually my podcast is called Compounding Project, how you can apply compounding to not only money, but other areas of your life as well. So my question to you is, we know how you have compounded your money, right? So I'm curious to know what other areas of your life have you applied the principle of compounding, and how, let's say if you're starting over, how would you have done that differently? I'm not talking about money, but other areas of your life.
Yeah, I think compounding is actually, it's myopic to think about it just in terms of money or assets. I think the bigger part of compounding is how to compound and have a great life. And in fact, if you study Warren and Charlie, the best lessons they have is about compounding goodwill and compounding great life. And so there's a number of different things you can do. We don't have the time today to go over it, but I would just say that you look at their example about, being selfless and helping the world in different ways, and the goodwill does compound and it does come back manyfold. And that's a great model to follow in life. So
thank you for your question. Mohnish, look who's behind you. So come forward, because the people who really did this, I did nothing, but it's these people. I guess Mohnish, you're in the crowd. Mohnish helped. No, stay there. But no, don't go. You can stay as well. In fact, Mohnish, why don't you thank them for me? Because you'll do a better job. Why don't you thank them for me?
Well, Guy, so Guy has a lot of difficulty firing people. Okay. And he'll tell you that, in about 15 seconds after meeting any of his staff members, I would tell him whether they're keepers or they need to be let go, right? And I'd repeatedly meet him and say, okay, Guy, so-and-so needs to be gone. Okay. And then a year later, they're not gone. And I told Guy, I'll do it for you. You don't need to do it. Just let me talk to them and it'll be done. And of course, he's too nice. He won't let me do that. And so, these thoroughly incompetent people, they suffered. These are the good people. They've suffered through with these incompetent people. I've had conversations, Chantel. Have we not had conversations? Yes, we've had a lot of conversations about these incompetent people that Guy wouldn't let go and they had to painfully deal with. So I just want to say, this is the A team. No need to make any changes. Great A team. We finally got there. It took probably 10 years to get there, but we got there. So it's wonderful.
Thank you.
I got there just before I shut my phone down for medical reasons, but whatever. Thank you so much. Thank you. And thank you, Mohnish.